Is on phone until someone called them, like a family member from another part of Canada, was like, Canada, is your daughter making videos? And I think my mom was like, I don't know, Lily, are you making videos?
Just making videos grew into an entire career. Today, Lily's YouTube channel has some 12 million subscribers, over 2 billion views, and guest stars like Michelle Obama, Dwayne "The Rock" Johnson, and Seth Rogen.
I think a lot of young girls are raised to believe that you're going to go to school and then graduate and then get married and then get a job and then have kids.
And Lily was on that path, all the way through a psychology degree at York University in Toronto. But when she started thinking about a career,
I started to immensely panic and think something was wrong with me because I tried to figure out my life and it wasn't working in that straight line.
It was 2010, and YouTube was only 5 years old.
I thought nothing of YouTube. I was probably the last person in my circle of friends to discover YouTube. And I remember when I did, I thought, this is so strange. There's people making videos in their rooms and other people are watching them.
So she figured, why not give it a shot?
I one day posted a video because I was sad and I wanted to be creative and happy.
She didn't know how to edit video or write scripts, so she winged it.
It was so bad and so cringe, and my expectation was literally nothing. I was like, I'm gonna put this video up, a couple of my friends are gonna watch it, probably make fun of me, and that's gonna be the end of this. The second and third video came from, wait, 70 people watched my first one, can I get 80 to watch the next one?
She kept creating, she kept posting, and the viewers kept coming. Lily had found an audience.
A lot of the comments were, oh my God, there's a brown girl on YouTube.
More specifically, Indian. Lily's parents immigrated to Canada from India, and Lily was born and raised in Scarborough, near Toronto.
My home life was awesome. My parents, even though I portrayed them to be quite strict in my videos.
Oi, Lily, where the rest of your skirt, huh? I teach you like this, to walk around like this, showing everything to everyone?
They actually aren't like that at all. They're pretty modern and pretty cool.
Your dress is short. Don't know what for.
And were pretty lenient with me. I mean, I got away with a lot of things. I was a brat. I was a brat.
She had a different idea of what she wanted out of life than other kids. In a grade school graduation slideshow, her classmates said they wanted to be lawyers and doctors.
And then I came up and I was like, rapper.
Making out with your friends, man. But then you say that you hate hoes.
I could just feel my parents being like, why?
Because that's just not something women really did in the Singh family.
I know there was a ton of people that weren't happy about my birth being a female, so I think, and that's some real-ish, but it's a real thing. The best thing I could have done to prove to so many people that didn't want my mom to have a daughter was to become Superwoman. What up, everyone? It's your girl, Superwoman.
It was the name of Lily's favorite hip-hop song by Lil Mo featuring Fabulous.
I love the song so much because it was one of the only songs at the time that was an empowering female song, where Lil Mo's going on about, like, I will save guys with my superpowers, and I will save girls with my superpowers, and I am Superwoman. I thought, this name that I've had for so long that empowered me when I was younger, I'm gonna make this my screen name. Maybe there should be a new series.
Superwoman didn't just burst onto the scene overnight with a viral video. It was a steady climb fueled by hard work.
The moment that I thought this is going somewhere and this could be a career was the first time I performed internationally. It was in India. And it was the first time where I was truly across the world and people knew my videos.
Singh has transformed herself from a bratty kid to an internet personality to a media mogul. She started a feature film, A Trip to Unicorn Island, in 2016. And her book, How to Be a Boss, hit the New York Times bestseller list in 2017 while she was on a 30-city international tour. Lily started out with the goal of getting millions of subscribers and financial security.
Hurry the hell up!
But after surpassing those goals, success has new meaning.
I've really come to terms with the fact that my definition of success is what's the best legacy I can leave behind. And it's not the number of views, the number of subscribers. It is the number of people that can say, this girl changed my life or changed something in my life positively.
CTE is often found in the brains of deceased athletes, military veterans, and others with a history of repetitive brain trauma. Hundreds have donated their brains to the VA Boston University Concussion Legacy Foundation Brain Bank.
This is a former NFL player who died in his early 70s, and this is a veteran who also died in his early 70s.
Dr. Ann McKee dissects these brains.
The hippocampus and the mammillary bodies are very important for memory. I can see that they're slightly affected.
McKee recently dissected the brain of former New England Patriots player Aaron Hernandez, who was convicted of murder and later committed suicide.
You'll see right away that the brain is showing signs of shrinkage. You can see the crevices in the brain that you can't see in the normal.
McKee says Hernandez's severe case of CTE impacted his decision-making, depression, and ability to control rage and aggression. Right now, she thinks we're underestimating how many people have CTE.
We were able to distinguish between CTE and controls and CTE and Alzheimer's disease. The next question is, can we do this in the blood, and can we do this in living people? And we aren't there yet with those answers.
But the need for a diagnosis in the living is motivating companies such as Quanterix in Lexington, Massachusetts, to work faster on technology that could diagnose concussions and CTE in as few as 30 minutes. Kevin Rosovsky is the CEO.
It's like a high-powered microscope. And so by doing that, we can see little biomarkers that you couldn't see before in the blood.
Quanterix received a grant from the NFL and just went public. Since then, its stock is up more than 40%. The company sells a machine called Simoa for $175,000 to other biotechs, hospitals, and researchers.
And for the first time in history, we're able to see brain health in blood, and that's a major breakthrough, and that's leading to less invasive testing, and we've already been able to see evidence of concussions, and there's the beginning evidence of being able to see the accumulated effect of concussions.
Quanterix is also trying to detect Alzheimer's disease, multiple sclerosis, and ALS. Rosovsky says he thinks diagnosing concussions will be easier than diagnosing CTE.
Diagnosing CT in the living probably is a couple years away. We're real excited to see the progress, but reducing some of that work into actual tests in a laboratory takes time. There's regulatory approvals. There's a lot of red tape that you have to go through.
Also in this race to diagnose CTE in the blood are Athlon Medical and Exosome Sciences. And New York's Mount Sinai Hospital is scanning for the disease in the living. But it's just one step in a series of questions for those with serious head trauma. There's still no cure for CTE.
Even if we had a great idea for a treatment, there's no way to test whether it's effective or not. So that's the enormous advance that we'll get if we can develop a biomarker for this disease.
In Boston, Ann Mostu, Bloomberg News.
Wine is a $300 billion global industry where one person's opinion can make fortunes or break them. That's because of this man, Robert Parker, and his newsletter, The Wine Advocate. For 3 decades, he dominated as the world's most influential wine critic. Now Parker's protege is building an empire of his own. Antonio Galloni runs Venice. Antonio, tell me, what are you trying to build at Venice?
Well, at Venice, we started with the idea in 2013 of building a world-class platform. We have a database of about 250,000 professionally written reviews. On Delectable, we have 7 million user reviews. Through Delectable, we also have a partnership with Whole Foods and several other partnerships that we can't announce just yet. And when you put that all together, what we have is something that no other company in our space can even come close to.
Do you think of yourself as the next Parker?
Not at all.
Why?
Because Steve Jobs said you can't live your life trying to be somebody else. So he's one of my biggest influences, and I've never wanted to be a replica of somebody else because a replica is never as good as the original. Bob is a genius, fantastic, one of a kind. We're going to be something completely different, and I have no desire to be some version of somebody else.
Different in what way?
Every decision that I've made at this company is completely anathemic to what Bob did with his company. I want our writers to be partners. All of my senior people are locked into the company. They all have equity or they have a path to equity based on business results. That's something that we never had at Parker. Our benefits are world-class, and everything that we've done at Venice is completely different from that model. When Steve Tanzer, who is the most experienced active wine critic in America, wants to work with us, that says something. When Alessandro Masnaghetti, who's the best cartographer of vineyards, wants to work with us, that says something. When Neil Martin, who's a superstar wine critic with enormous experience in Bordeaux and Burgundy and the former lead critic at The Advocate, wants to come and be part of our team, that says something.
You make it sound like The Wine Advocate was a disaster as a company and a miserable experience as an employee.
No, it was great because I got to work with Bob Parker when he was at his prime, you know, and Bob was like a second father to me, and we talked on the phone all the time, and he gave me great advice.
Can anyone's palate dominate the wine criticism business the way Parker's did? And should anyone's palate dominate it the way his did?
I just think the world is very different today. You know, it's just a totally different world. It's probably not healthy to have a single person dominating the world.
It's not even wine criticism, it's the wine industry.
Yeah, that's probably not the healthiest thing in the world. But I think that there's just such an opportunity right now with social media and technology to reach such a massive number of people that I think it's possible that 1 or 2 people will actually have more influence than Bob Parker did, because they will, again, this goes back to your first question, not trying to be a version of somebody else. You see this in sports all the time. It's like, oh, well, nobody will ever beat this record. And then somebody comes along, you know, it was like tennis, Pete Sampras. Nobody's ever going to win as many Grand Slams. Now you have 2 guys who are ahead of that and 1 knocking on the door. And so I think a lot like that.
You're a former investment banker. How does that inform and influence what you're doing and what you've done?
My generation has had to deal with a lot more challenges. That's why I think we're actually much better poised for the future. My first job in finance, the first thing that happened was long-term capital, 1998. Then the tech bubble melted down. Then there was a mutual fund trading scandal. You know, that was all like within about 5 or 6 years. And these are the things that I had to deal with as a young executive. My peers who were 20 years older didn't know how to manage in crisis. They'd only seen Black Monday. They'd just been in a big bull market. It's very different. So I'm very lucky. People of my generation or a little bit younger have actually had to deal with a lot more crises. I think that's actually good for learning how to cope with challenges in business.
From the outside, it kind of looks like you're trying to demolish the house that Parker built, right? You left The Wine Advocate.
Yeah.
You merged with one of his chief rivals.
Yeah.
And you just hired his successor, Neil Martin.
Mm-hmm.
So are you?
I think what that says is that all the best people want to work at our company. And that's really what we strive to create starting in 2013. We wanted to create a world-class company that would attract the best-in-class talent, and not just on the content side, on the technology side, on the digital side, our office, and at every level, what we're trying to, we only hire superstars, and we're looking for those superstars.
In the world of professional wrestling, there's something called a swerve.
Hulk Hogan has betrayed WCW!
Some examples. These tag team partners are called babyfaces, or the good guys. Then one of them swerves when he super kicks his tag team partner in the head, quickly assuming the role of the bad guy, or what the wrestling world calls the heel.
Are you kidding? What a despicable act that was!
Or a match is almost lost when, what's that? The superstar wrestler appears out of nowhere sprinting down the aisle to save the match.
That's the Warriors music! It's the Ultimate Warrior!
That's a swerve. So it should go as no surprise that World Wrestling Entertainment, known as the WWE, the most popular brand of sports entertainment in the world, is prepared for any swerves that come their way. So here's the story of how the WWE learned to see the swerve coming. So I spoke to Bloomberg reporters Felix Gillette.
I'm a writer for Bloomberg News for the global business team.
And Kim Basine.
And I'm the U.S. luxury reporter at Bloomberg.
To find out exactly how the WWE is positioning itself for an all-out global invasion, which starts with a massive change to their lucrative pay-per-view model.
WWE basically pioneered the pay-per-view model on cable. I remember as a kid, when the pay-per-view events came up, all of our friends would scramble around and try and get one of the parents to pay for it.
But in 2014, they took a huge risk.
They saw a little bit sooner than some of the other entertainment brands that where this whole thing was moving was away from cable and satellite television and towards on-demand streaming video apps. They made this risky decision, in essence, cannibalizing that pay-per-view model, which they had essentially built.
And after some early turbulence, it's working. Roughly 1.5 million people are paying $9.99 a month for the WWE app, making it the 5th most popular streaming OTT service. This adapt-or-die approach is in the WWE's DNA. Over the past 30 years, the company always seems to think 2 steps ahead. In the early 90s,
WWE was at its most threatened when Ted Turner took them on with WCW,
which stands for World Championship Wrestling. And back then, the WCW was winning the ratings war. So in order to compete with them,
WWE had changed its product from a family-friendly kind of cartoonish style to this really raw. That's why they called their show Raw. It was this raw style of wrestling.
With violent, outrageous, reality-inspired plot lines and aggressive personas.
From a 16-foot ladder!
And they won that fight against Ted Turner. And they bought WCW.
The early 2000s ushered in an era of testosterone-driven programming aimed at the red-blooded American male.
Bra and panties matches, and people smash each other over their head with like barbed wire bats and things like that.
Until 2015, when WWE fans started a hashtag Give Divas a Chance. Since then, WWE has hired 40 more female wrestlers, and that growing cast of female characters was part of a much larger plan.
They started to try to appeal to a broader set of people.
Let's attract more female fans. And after we've attracted more female fans, let's attract more international fans. They're broadening their base, and they're doing that in large part to make it more advertising friendly.
And not just friendly to advertisers.
They're trying to build up their fan base in China. They're trying to build up their fan base in Europe. They, already have a pretty good fan base in India.
India is a place where they already have an established wrestling culture.
Because of the gigantic Indian wrestler, the Great Khali. But there's still a lot of work to do. While the WWE set a revenue record in 2017, only 30% of it is coming from an overseas audience. And there's one person whose responsibility is to grow that number.
The buck eventually stops at Vince McMahon, no matter what's happening within WWE.
Yeah, he's a very controlling guy, and it's a very, very, very tightly scripted company.
And that goes all the way down the board to big stars' entrance music. And their outfits and things like that.
So with a CEO like McMahon always planning 2 moves ahead and an aggressive push into multiple international markets, a big issue is money.
It's hard to do all those things simultaneously without committing a huge amount of capital to it.
And that's where the WWE becomes an attractive company for buyers.
Potentially, one thing that could happen with WWE is they could benefit by being acquired by a bigger technology or telecom company, an Amazon or Facebook Facebook or a 21st Century Fox.
So with a market cap of $2.8 billion, the advantage of owning 100% of their own content, and a rapid consolidation spreading throughout the entertainment industry, it looks like the WWE is well positioned, even if there are swerves ahead.
Our world is changing. Every day, it changes a little faster. Some changes are too small to see. Others, too big to handle. Sometimes, change feels slow. So slow, we don't even notice. Other times, it happens all at once, and we can't keep up. For our climate, change means many things. And between too small to see and too big to handle, there is a whole world of difference. The clock is ticking. This is Bloomberg Green.
Saving the seas. This week, the deep-sea diver who stopped writing the ocean's obituary to find a solution. Enric Sala tells us why the next 10 years matter most. And globalization needs to get greener. Shipping accounts for nearly an eighth of all transport emissions. How can the industry clean up its act? Plus, protecting coastlines comes at a huge environmental cost. But one Israeli startup found a way to keep the sea out and the animals in. From London, I'm Anne-Marie Hordern, and this is Bloomberg Green. After more than a decade of studying the ocean as an academic, Enric Sala realized he was writing the ocean's obituary. He quit his job and became a full-time conservationist. As an in-house explorer for National Geographic, he's clocked more than 5,000 open water dives. He's also founded Pristine Seas, a project that combines exploration, research, and media to lobby countries to protect their oceans. To date, it has helped create marine reserves equivalent to half the size of Canada. I spoke to him about his mission and why it's so urgent.
The state of the world's oceans is really bad. We have lost 90% of the large fish in the ocean. Sharks, groupers, cod, tuna. More than half of the fish stocks are overfished, which means that we are taking them out of the water faster than they can reproduce. More than half of the ocean is affected by industrial fishing, and global warming is killing coral reefs all around the world. The ocean is in a trajectory of decline.
Can you just visualize for our viewers who never get to see the kind of things you are able to see, what an ocean and healthy ecosystem looks like versus one that's next to a bustling economic and industrialized area?
Coral reefs in the United States, in the Florida Keys, are down to only 2% of what they used to be. Before, 80 to 90% of the bottom on a coral reef in the Caribbean was covered by live coral. Now, Florida Keys have only 2%. The average in the Caribbean is about 5% of the bottom covered by live coral. The rest is covered by slime and seaweed. And most of the fish you can see are this big. And it is very, very rare that if you jump into any place in the Caribbean at random, you see a shark. It's very, very rare. Now, let's go to Millennium Atoll, for example. An atoll that is uninhabited and fished south of the equator in the Central Pacific, belongs to the Republic of Kiribati. 2009, we conducted the first underwater expedition to these islands, and I still remember the first time. Jumped over the side of the boat, and as soon as the bubbles cleared, I was surrounded by 15 gray reef sharks. After a couple minutes, the sharks decided that we were boring, and they went back to do their thing. And you look down, 90% of the seafloor is covered by thriving coral, and it's full of fish, and a sea turtle comes by. Now, this abundance that we rarely see anywhere except in well-managed marine reserves. This is what the ocean used to be like, and this is what we have learned from going to these pristine places.
And you write in your book that you're writing the obituary of ocean life. What's the cure?
The cure is doing less harm. Basically, there are three things that we are doing to the ocean. One is we are taking fish out of the water faster than they can reproduce. Two, we are turning the ocean warmer and more acidic because of man-made climate change. And three, we are throwing in everything that we don't want, our waste and our plastic. We need basically to reverse these trends.
Does this mean that a lot of this falls to governments and their policies?
That's a big part of it, because it is governments that regulate fishing and mineral extraction and oil extraction. It is governments that have the legal authority to create large marine reserves in the ocean. But
While Enric Sala explores what lies beneath, a new satellite is giving us data from above.
We'll learn more about our oceans and climate change, but from space. A new satellite's been launched from California. Its mission, track the accelerating rise of sea levels.
Well, the main instruments on board include a dual-frequency radar altimeter. This is the primary instrument of the mission, and that's the one that's measuring sea surface height, significant wave height, and wind speed over the ocean. And from those measurements, we can actually have the superb measurements that we expect of sea level rise.
Data gathered from Sentinel-6 will be used alongside information from other satellites to build as complete a picture of the oceans as possible.
With a long record, we can precisely measure the acceleration. We eventually can detect new regime, tipping points. For example, if there is a runaway in the melting of Greenland or Antarctica, sea level will record this runaway change because it is an integrator of all changes that are occurring in the climate system. So we will be able to see some change, big change in the global climate.
The National Oceanic and Atmospheric Administration expects that sea level rise will increasingly threaten U.S. coastlines. One example, the southern tip of Manhattan is expected to flood 20 to 40 times a year by 2030.
11 of the 15 largest megacities are located at the coast, and this number will double. The number of people living in coastal area will double by 2060. So, knowing how much sea level is rising at the coast and how much it will rise in the future in coastal areas is as obvious. It's obviously a major goal for human beings.
Coming up, from sales to steam to oil, the shipping industry is no stranger to change. But how will it navigate the next transition? This is Bloomberg Green. From Bloomberg's European headquarters in London, I'm Anne-Marie Hordern. This is Bloomberg Green. Now, for your roundup of this week's latest climate news, Jennifer Zabazaja has your Green in Brief.
Here's the climate news you need to know. Deforestation of the world's largest rainforest has hit a 12-year high. More than 4,000 square miles of the Amazon rainforest was destroyed in 2020. That's a 9.5% increase from a year earlier. Government data shows that destruction has soared since President Jair Bolsonaro took office and weakened environmental enforcement. The Amazon is home to millions of species and plants and is critical in the fight against climate change. Bitcoin is hitting all-time highs, but at what cost to the environment? The cryptocurrency is energy intensive, and there are concerns if it becomes mainstream. According to MIT, back in 2018, Bitcoin's carbon footprint was almost as big as Portugal's. Want to get better at tackling climate change? We'll hire more women. That's according to Bloomberg New Energy Finance. Firms with 30% or more women in top jobs tend to perform better when it comes to the environment and are more likely to set clear climate goals. Shopping online is more popular than ever now, but the price of convenience is measured in CO2, and more deliveries means more fuel burned and more packaging wasted. So what can companies do? Well, many are becoming more efficient and sourcing more clean energy for their data centers and warehouses. And England's farmers will be paid to go green after Brexit. As European subsidies are phased out, they'll get new money to encourage them to produce healthy, sustainable food. Poor farming practices are one of the leading drivers of water pollution and the loss of biodiversity. I'm Jennifer Zabazaja in New York. Anne-Marie, back to you.
The shipping industry is more than just the grease on the wheels of globalization. It's its chief enabler. 11 billion tons of goods are transported by ship each year, the biggest contributors being 2 billion tons of oil, 1 billion tons of iron ore, and 350 million tons of grain. According to the International Chamber of Shipping, 80% of Europe's imports and exports happen over the seas. And for such a vast industry, it also contributes its fair share of emissions. Shipping makes up 12% of global transport energy consumption. So how does it clean up its act? Earlier, I caught up with Bloomberg Green reporter Laura Milan about just how big of a challenge this is going to be for the industry.
One of the main issues is size. So about 90% of the world's cargo is moved by ships. So obviously changing such a huge industry is not going to be fast and it's not going to be easy. The second issue has to do with technology. So ships obviously travel for many days at sea. It's not as easy for them to refuel as it would be for a car, for example, going on a road. And the sector still hasn't found a technology that's economically viable and that's zero emissions, an equivalent to the electric batteries for cars, for example.
But actions are being put in place to make the industry a bit more environmentally friendly. Walk us through those steps that they're taking.
That's it. So there's a first step that would involve using low emission fuels or biofuels that would significantly reduce the existing emissions. And then at regulatory level, when it comes to the policy and the governments, there are steps being made as well. I would say that the most significant ones come from the European Union, which started to track emissions a few years ago and is now looking to include shipping emissions in the emissions trading system. So that would significantly reduce and help calculate the emissions from the shipping industry. Now, China is taking similar steps. So at the moment, regions need to report shipping emissions to the central government. And finally, we have the International Maritime Organization with a pledge to reduce shipping emissions by 50% in 2050. Now, we must say that that pledge has been considered insufficient by environmental groups, but at least some steps are being taken.
So to get to 2050, the industry obviously is going to need to start tapping some new technologies. What new technologies are you seeing being introduced into the shipping industry?
So we have seen pilot technologies being developed for years now, but what's interesting about this current moment is that we're seeing big players invest in these technologies that are not yet economically viable, but that one day might be. So for example, we are seeing earlier this year, the world's largest agricultural commodities trader, Cargill, saying they will invest in attaching sails to their ships so they can make any technology that they run their ships on more efficient. Similarly, we have seen a spin-off of Airbus, the aeronautics company, developing a similar application with kites. We have been following also developments in hydrogen. So at the moment, hydrogen fuel seems like a good option, a possible option when it has been developed and when it becomes economically viable. And we have Vestas, for example, the world's largest turbine maker, developing some ships that will be able to run on hydrogen in the near future.
Coming up, rising sea levels means humans need to get creative when it comes to coastal defenses. But how do we protect both ourselves and the environment? One Israeli startup may have the answer. That's coming up next. This is Bloomberg Green. In London, I'm Anne-Marie Hordern. This is Bloomberg Green. After water, what's the resource that humans use the most? It's concrete, 3 tons a year for every person on the planet. And engineers estimate it's used twice as much as all other building materials combined. And it comes with a huge environmental cost. Concrete, not just in cities, it's a common feature on our coastlines too. And that's taking a toll on biodiversity. But one Israeli startup has found a way of making sea defenses stronger and encouraging life to thrive.
If you take a look at concrete structures like breakwaters or seawalls, the water around them is often clear. That's not actually a good thing, because it means there's no life. Marine species are actually most abundant in coastal areas, but it's also where us humans prefer to live too. So when we build here, we drive away marine life.
The concrete in the marine world has a lot of additives, a lot of chemicals, and some of those materials are actually leaching out, and they're actually prohibiting marine life to thrive. If we keep developing without any regards to natural communities, there is a tilting point from which beyond we cannot really go back.
In the coastal city of Tel Aviv, an Israeli startup wants to revolutionize our urban coastlines. Their sea defenses are transforming lifeless man-made structures into teeming ecosystems. They do this by replacing standard concrete with their own special cement formulas.
As opposed to regular cement-based concrete, e-concrete includes certain elements that enhance the growth of marine flora and fauna of plants and animals. Our admix, which is kind of our secret sauce, is basically kind of sealing the concrete, making it less aggressive for the marine environment. That once we add it, we enable life to flourish.
In the lab, the team run tests to identify what mixes will work best for marine life.
So we take really ice cube-sized concrete slabs of different compositions, and we put larvae, 20, 30, 50. We need to have a lot of replicates. We're geeky scientists, so we have to have a lot of replication and controls. And then within a few days or just a few weeks, we can get an answer on their preference. So obviously, if they die, they have a very low tolerance to that specific concrete mix design. And if they thrive or they flourish, we can quantify that very quickly.
E-concrete says it typically sees double the biodiversity of regular grey concrete. From fish and sea caterpillars on their armour blocks to crabs on these tidal pools that sit on the shoreline.
This unit holds water during the low tide, so it's always moist, and therefore it has a very comfortable habitat for crabs and sea anemones and sea stars, etc. These pools have been here for less than 3 months, and this is already what you can see. It's covered with life. See the rock around it, which has been here for probably 10, 20, maybe even more years, only has a thin layer of green algae, and that's it.
As well as the composition of the cement mix, e-concrete designs its products specifically to the marine environment it will be deployed, to create niches for endangered species, or to develop nurseries like these oyster beds. The final part of the equation is creating complex surface textures to mimic natural rock or coral, an environment that helps anchor young organisms.
When concrete elements are being cast, the typical goal is to have a very slick surface, very, very smooth. The idea is to get the water to flow right across it. When we're designing e-concrete with a rough surface, we want to do the complete opposite. We want to slow the water when they are crossing the structure so that the larvae can actually adhere and attach to the surface.
E-concrete has to offer its clients more than just ecological credentials. Over time, they've discovered that creating hospitable habitats for marine life adds another advantage, one that is surely hard to ignore.
We've seen evidence to the fact that the growth of the organisms on the concrete create kind of a layer of defense. Just the addition of weight, we can actually gain stability and strength over time.
This is let's say the unit when we put it in the water. And this is after a year in the water. And what you can see here is all the oysters are completely covering it. We designed the units so they can withstand the forces and perform in terms of structural performance, but they can also be a backbone for ecological enhancement.
The company tests its miniature designs in tanks full of real seawater, rocks, plants, and animal life from around the world.
What we're looking for is the accumulation of calcium carbonate on the surface of the concrete of different mixes and different designs. This is the process that we call biogenic buildup. So with time, we get a buildup of calcium carbonate that is sourced from marine organisms on the surface of the concrete. And we actually encapsulate the concrete with a natural rock. So when the organism dies, in case of a coral, it will die, and then another coral will sit on it, and that's how a reef is growing.
The hope that our man-made structures could become stronger over time also means better economics.
The units require less maintenance and could therefore stay in the water for longer. E-concrete, though, is just a few years old, so it needs more time to really quantify the longevity of its products. But the company are certain their products are better for the environment, and not just in terms of improving biodiversity.
We're kind of trying to offset some of that immense carbon footprint of the concrete industry.
Construction is responsible for about 11% of global carbon emissions. By adding a biological crust to their products, e-concrete prevents some CO2 from being released into the atmosphere.
For every kilogram of calcium carbonate being created by those marine organisms, we're offsetting 120 grams of CO2. So think about building a port infrastructure or a city waterfront that is an active carbon sink. I think that's a great advantage of the technology.
That does it for this week, but let's keep the conversation going on Twitter. Follow us at Climate. I'm Anne-Marie Hordern, and this is Bloomberg Green.
This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine. Plus, global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
Yes, indeed, everyone. Welcome to Bloomberg Business Week on this Tuesday, July 13th, 2021. Carol Masser along with Tim Stenovic. Where shall we begin on this Tuesday?
Inflation.
Oh, that's an interesting choice.
Yeah.
I agree with you because I do think when it comes to markets, they're focusing so much on that. We're going to break that down. We are also going to break down JP Morgan and Goldman reporting mixed earnings.
Yeah, and we're going to have the latest on that in just a few minutes and the market reaction to those. Plus, John Rogers of Ariel Investments on the markets and investing and reducing the wealth gap.
Yeah, so well known to our audience. So we're going to talk about the markets and so much more with him. And then AB InBev's CFO and their Chief Sustainability Officer. I just got off a panel with them for the Bloomberg Sustainable Business Summit on doing a record sustainability-linked credit facility. Earlier this year, it was over $10 billion.
Wow, look forward to hearing more about that.
All right, first up, let's get you going on this Tuesday. Yeah, there's a lot going on. Hey, Charlie Pellet.
Hello there, indeed. Let's begin with those bank earnings because both JP Morgan Chase, Goldman Sachs, they're lower right now. JPM lower by 1.4%. Goldman after earnings down by about 0.8%. Stocks falling from records. Bond yields jumped after a U.S. debt auction was met with tepid demand in the wake of data showing consumer inflation unexpectedly accelerated in June. Yields climbed after the Treasury Department sold $24 billion in 30-year bonds at levels higher than just before the bidding deadline. right now. The 10-year at 1.41%. The 10-year's down 15 seconds. The S&P, the Dow, NASDAQ, all on the minus side. NASDAQ 100 index right now is unchanged. The S&P is down 9, a drop there of 0.2%. The Dow also down 0.2%, lower by 79. NASDAQ down 41, a drop of 0.3%. Apple and Goldman planning a, quote, buy now, pay later service. That headline now crossing the Bloomberg Professional Service. 10-year yield again, 1.41%. We've got gold, little changed, up 15 cents the ounce at 18.06. West Texas Intermediate crude up 1.7%, 75.31 a barrel. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Yes, it is. All right, let's get to the market drivers report. And let's set the Business Week agenda on this Tuesday. Dave Wilson, stocks editor at Bloomberg News in our Interactive Broker studio. So too is Carl Riccadonna, chief industry economist at Bloomberg Economics. And because Tim said inflation is the most important thing, we're going to start with Carl.
I think it is today.
I think it's going to be the most important theme for a lot more than just today. This morning we had the CPI data for June, well above even the highest forecasts submitted to Bloomberg for both headline and core. So coming in hot, hotter than expected. However,
economists getting it wrong again?
Economists got it wrong, which is why we like weathermen, because they make us look good. But as we dig through the details here, again, we can see this continuing narrative of reopening-related price categories really dominating the increase. If we just take a few of them, for instance, new and used motor vehicle prices, we all know what's happening on that front.
Right.
We take rentals. If you can't buy a car, you need to rent one. So car rentals, hotels, airfare, admission.
Guess what, everybody? The economy's reopening.
Yeah, all of the things that were the most depressed categories last year are not surprisingly going through this reopening wave, and so it looks like there's a big price increase. The categories I mentioned account for 10% of the CPI. They accounted for 56% of the month-on-month increase. It's getting everyone so worked up. So it's not to say inflation is not picking up. Absolutely, we're seeing a broader acceleration in price pressures. But to really understand the trend, we have to take those few unique categories out of the picture, and then we can see that, yes, price pressures are flaring, but not to the degree that those headline numbers would otherwise
So it's like a CPI
suggest.
X.
It's Xing out the reopening categories, and critics will say, well, you take out whatever went up, and of course you won't have as much of an inflation story. But to really view this in an objective fashion, the way that monetary policymakers want to look at this, you have to take into account those transitory categories. Another way of slicing and dicing the numbers is to look at goods versus services. A lot of goods prices are simply a reflection of what we are importing into the country, right? Service prices are reflective of domestic economic conditions, and service prices are what gets the Fed hot and bothered if we start to see some boil up. And it is really two very different series. Goods prices are going through the roof. Service prices have started to reaccelerate to some degree, but they're basically running on average with the 5 years prior to the pandemic. So not a big change, of course, there, which is why you see such a muted reaction in the long end of the curve on today's data.
Okay.
So, Carl, what's a realistic way for us to think about the end of this reopening heat that's actually happening when it comes to these numbers?
Yeah, well, if we look back to the minutes of the last Fed meeting, we can see the policymakers were surprised to some degree on both the intensity of the pickup in prices and also the duration or the sustainability of it. So they still think this is a transitory development, but they think it's going to run hotter and longer than they initially anticipated. Nonetheless, as we get into the back half of the year and start to see some of these supply chains normalizing, maybe we're getting hints of that with lumber futures.
Yeah, they're
down a lot.
Wiping out the gains for the year.
Yeah, which is transitory.
You're seeing some moderation happening in the housing sector, and some other categories. So the old adage, I'll sound like a broken record here, but Mike McGlone, if you're listening, our commodities strategist.
You're going to say the tiger thing?
In the commodity sector, the cure for high prices is high prices because it brings, supply elasticity kicks in.
Right.
And if you can, sell something at a very high price, you ramp up production, and then that creates the downdraft. And that's what we're seeing in lumber futures.
Works with Uber. So Dave Wilson, you've been so patient, but we wanted to kind of break down all the economy. The markets, we off our highs, kind of what's breaking down here a little bit?
Well, as much as anything, I mean, what you're seeing is some of the stocks associated with the reopening trade, if you will, taking hits, whether we talk about the airlines, American, Delta, United, all down more than 3%. Cruise lines, similar story with Carnival and Norwegian. Even Live Nation, you know, the concert promoter and ticket seller, down more than 3.5%. So that kind of jumps out. And beyond that, I mean, you have the results out of two of the biggest U.S. banks, which, you know, they didn't go over all that well. J.P. Morgan Chase has been lower since the opening bell. It's down 1.2%. It's all about cost there. Whether you look at the second quarter or the year, they were higher than analysts were anticipating in a Bloomberg survey. We've seen Goldman Sachs, which also had numbers out, kind of fluctuate between gains and losses as the day has progressed. It's off 0.4%. Now, I mean, they had quite the quarter for their investment banking business with revenue up 36%. On the other hand, you know, bond trading revenue didn't quite measure up to what analysts were looking for, which was also an issue, as it turned out, at J.P. Morgan.
All right. What's next on the economic front?
Well,
we've got Jay Powell.
Sure. We have some big things coming up.
Yeah.
So we have some inflation news. We have PPI tomorrow, import prices on Thursday, and Jay Powell heads to Capitol Hill for the semi-annual testimony. Really, this is his final semi-annual testimony before he gets renominated, potentially renominated. So
Does
this is
that
kind of like the
impact
last
Fed chiefs?
job interview. His term is up in February of next year. So the next
Everybody liked you until that last one.
So he
Does he
has
want to keep the job?
he has said he enjoys the job, and he doesn't want to talk about his second term or not, but he, I think, would definitely be interested in a second term. And you know, his stewardship of the economy throughout the pandemic certainly warrants him riding to victory and kind of seeing it through. Right? There's a lot of accommodation he put in place. He now needs to oversee the unwind of that.
And just quickly, Dave, safe to say that equity markets watching it too. They like continuity, I think, sometimes when it comes to Fed heads.
Oh, absolutely. And then, of course, tomorrow we get Bank of America, Citigroup, and Wells Fargo. So big day for financial earnings, arguably even bigger than today. All those stocks, by the way, down more than 1%.
Got to say, I just talked with the CFO and the Chief Sustainability Officer at AB InBev, and they don't seem to be too concerned about their supply chains right now.
Things are starting to work out. One of the questions, actually, with the banks is loan demand. It's just simply not there.
Yeah, well, that's interesting. All right,
To be continued.
Carl Riccadonna, Carl Riccadonna, and of course Dave Wilson. He'll be back a little bit later on. Go ahead.
All right, let's do the Bloomberg Business Week Bite of the Day. It's one number that tells us a lot. Today's number is 2. The popular short video app TikTok told its employees on Monday that some will be offered the option to work remotely for up to 2 days a week after they return to the office. That's according to an internal message seen by Reuters.
2 days.
Yeah, sounds good.
It's an option.
Not
right?
bad.
Not bad. All right, let's get a check on world and national news. Nancy Lyons waiting patiently in our D.C. newsroom. Hey, Nance.
Hey, Carol. Texas Governor Greg Abbott is threatening to arrest the 57 Democratic state lawmakers who fled Texas and traveled to the nation's capital rather than see new voting restrictions passed. Bloomberg's Irv Chapman reports.
Texas Democrats in the U.S. Congress hosted the group at a Capitol Hill news conference. Representative Rafael Anchia spoke.
Anybody in the state of Texas who needs to exercise the right to vote should do so freely, and we are not going to buckle to the big lie.
Texas legislator Symphonia Thompson.
When I look at the African American Museum, I thought about the struggle of my people fought in this country to get the right to vote.
The Texans urged Congress to pass a new Voting Rights Act, since the Supreme Court overturned a key provision of the one that passed in 1965. In Washington, Irv Chapman, Bloomberg Radio.
In a short while, President Biden will be addressing voting rights in a speech at the National Constitution Center in Philadelphia. White House Press Secretary Jen Psaki says he'll be presenting the moral case for why denying the right to vote is a form of suppression and a form of silencing. Teams in Surfside, Florida continue to sift through the rubble of the condo collapse. Miami-Dade Mayor Daniela Levine Cava says the death toll is now up to 95, but the number of unaccounted for has dropped.
238 people are now accounted for, and 14 people potentially unaccounted for.
Cava says 85 of the 95 victims have now been identified. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons.
All right, Nance, thank you so much. You are listening to Bloomberg Business Week. Carol Massar along with Tim Stenner. A couple stories here. that caught our attention having to do with the global financial community. This one by our Bloomberg News team out of Asia, China. Specifically, they're talking about two of the largest investment banks in China. They are making broad cuts to travel budgets that will impact junior bankers as well as senior directors as they look to rein in costs and boost profitability. So starting this month, Tim, CSC Financial's managing directors, domestic travel will be downgraded to economy. And second class are hard berth train seats, according to a memo seen by Bloomberg. Larger rival Citic Securities also asking managing directors to fly coach, according to a separate memo, which did not specify which class of travel they were previously offered.
Tightening the belt a little bit. The cuts are another example, Carol, of how policymakers are pressuring the nation's biggest state-owned financial groups to reduce salaries and costs to support China's recovery from the pandemic. Remember, financial firms were given details on how to limit pay at the beginning of last year. That was by the Ministry of Finance. And entities, including China's massive sovereign wealth fund and its biggest bank, they were affected. That's according to people with knowledge of the matter. I should say that spokespeople for Citic Securities and CSC Financial, those two firms that you mentioned, did not immediately reply to emails seeking comment.
And they talk about all of this maybe not stopping executives from traveling, but it might dampen morale among bankers used to more attractive perks. So we've seen, it's interesting because here in the U.S., right, bonuses and things are being, certainly to junior bankers and stuff, stepped up, but a little bit of a different story, as we know, in China. Another story by our Jenny Serrain, just quickly. Citigroup is going to let U.S. retail customers bet on stocks without paying fees, the bank trying to expand its wealth business in the face of fierce competition from Silicon Valley ventures, discount brokerages, and big banking peers. We're going to talk about this a little bit with John Rogers of Ariel, kind of the changing dynamics in the financial sector.
Yeah, this one from Citi is called Citi Self-Invest. It's available to checking account holders. Then it'll be later marketed to more people. That's according to David Poole, who heads the U.S. Consumer Wealth Management business. It's a zero-fee deal, and it applies to individual stocks and ETFs, but will later add other types of investments like mutual funds or options, he said.
The financial world is changing, being disrupted by those innovators. This is Bloomberg.
continues.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. U.S. stocks retreating from records. Bond yields jumped after a U.S. debt auction was met with tepid demand in the wake of data showing consumer inflation unexpectedly accelerated in June. 10-year yield right now 1.40%. We've got the S&P down 9, down 0.2%. The Dow also taking a breather, down 66, lower by 0.2%. NASDAQ down 39, a drop there of 0.3%. The NASDAQ 100 index, though, at a record up less than 0.1%. Russell 2000 down 1.4%. Gold up 83 cents the ounce, little changed at 18.07. West Texas Intermediate crude up 1.6%, 75.28 a barrel. Apple is working on a new service that will let consumers pay for any Apple Pay purchase in installments over time, rivaling the buy now, pay later offerings popularized by services from Affirm Holdings and PayPal. Shares of Apple, they're up 0.7% at a record. Goldman Sachs, also after earnings, trading lower now by 0.6%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Charlie, of course, breaking down the trade, and we're watching banks, as he mentioned as well. And we've been watching a couple of the names when it comes to their results. JP Morgan is down 1.3%, and a quick check on Goldman Sachs again. It is down just about 0.5% off its lows of the days.
Yeah, let's get right into it with Allison at Williams, Senior Global Banks Analyst for Bloomberg Intelligence. Okay, so here we are, not quite halfway through big bank earnings, Allison. How would you summarize what we know so far based on the two banks that reported today?
So I'd say no big surprises, but really sort of a continuation of the trend in terms of some of the key concerns around net interest income and higher expenses. So the key for investors that are really focusing on is the potential for loan growth to return in the second half. Banks really need that to help boost their net interest income. Trading was very good in the quarter. On the equity side of things, fixed income down as we expected. We expect further normalization in the second half. The big surprise out of the investment banking arm of the businesses was merger and advisory. We expect that, mergers and acquisitions, the advised business, we expect to continue to be strong in the second half. But that's a small piece of it. And so in general, we have the big capital markets piece normalizing. We have net interest income, a little bit disappointing just because consumers are not borrowing. Corporations are using cash to buy companies. Consumers are using cash to fund their spending.
Well, it's interesting. Well, when it comes to borrowing, is it just consumers and businesses aren't interested? Or is it that the banks are picky about who they give loans to?
It's really more about the cash that corporations and consumers have on their balance sheet.
Okay.
For consumers, it's really it's been fueled by the stimulus. So our economics department, Bloomberg Economics Department, has calculated over $2 trillion. And what we've seen with all the stimulus payments that have come so far is consumers have used that money to pay down debt. So that's healthy. And they're spending, but they're just paying that out of savings. And then on the corporate side of things, as you recall, a year ago when the pandemic took hold, corporations drew down on their credit lines at banks. However, when the capital markets opened up, especially the large corporates, tapped those capital markets. So we've seen very strong debt issuance over the past year, and in fact, in the most recent quarter, very strong high yield issuance. So they're continuing to raise funds. And then on the commercial side of things, it's really that, again, we need the demand side to pick up. So it's not, the banks are out there, they have tons of deposits, tons of liquidity, they want to make loans, but the demand is just not there yet.
Yeah.
So I wonder what was expected from shareholders and if their expectations were not met, especially when it comes to JP Morgan, because shares down by more than 1.3%. It doesn't sound like there was that much that was surprising.
Well, yes. So I would keep in mind it was a very strong quarter, but most of the strength that we saw were things that had been expected. We had a huge reserve release. Again, that's something that investors are expecting. I guess the new news, and again, net interest income disappointing, but we had sort of, been trending that way over the last several quarters. But the new news in terms of expenses, and expenses, I think, are something we're going to continue to be focusing on this week across the banks. J.P. Morgan got it to $68 billion of expenses in January. That's gone up to 69, to 70, and now today, $71 billion. And I do think that, part of it is because the revenue is better, but part of it is they're investing. And I think that even though investors might be disappointed today, J.P. Morgan has shown over the last several years this ability to fund what we call the virtuous cycle. So they're spending more, but that's helping them to make more.
Right. It's longer term investments.
Correct.
I know
we all want management to think long term, and so I think we need to think long term along with them. And with the incredible trading that we've had over the last couple of years, we think it's actually healthy that the banks are investing this, especially with all the talk about fintech, all the competition from fintech. And everything going on that front.
Well, exactly. We just talked about Citigroup specifically, right? Like, looking at fintech, I mean, they're all staring it down. Citi debuting that no-fee retail trading to compete with, others. So a little bit of an opener for the rest of the big banks. We're going to go here for what? Citigroup. We've got, Bank of America. We've got Wells. Tell us what you're watching out for.
So with Citigroup, they had actually already guided to higher expenses for this particular quarter. We're going to be listening to see what the guidance is for the full year. We think the expense story there is a little bit more negative because a lot of the driver there is that they have to spend more to get sort of their systems in compliance. So they have some regulatory concerns and issues. So that expense spending where it's not generating revenue is a little bit less positive to us, but that's the main thing we're looking for them. Bank of America, similarly, they last quarter guided up expenses for the full year. Wells Fargo already has had elevated expenses. We're hoping them to come down. For all those banks, we're going to be looking in terms of, again, what is the loan growth outlook? What is the net interest income outlook? And then one thing we didn't touch on, prime brokerage business, very strong. Will Bank of America and Citigroup also show some strength there, gaining some share in the wake of Credit Suisse's pullback?
You did it. You covered the universe. You're incredible. Allison, thank you. Bloomberg Intelligence Senior Global Banks Analyst Allison Williams. This is a busy week for her. We know that she's joining us on the phone in New Jersey.
It's just beginning.
I know. Earnings off and running. This is Bloomberg.
Broadcasting live from the Bloomberg Interactive Brokers Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 1061 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
You are listening to Bloomberg Business Week. Carol Masser along with Tim Stenovic in our Interactive Brokers studio. So coming up, we are going to talk a little bit about an interesting story that caught our eyes. It's among the most read, has to do with Barry Sternlicht.
I thought you were going to say we're going to the mall. Or not, and that's probably the issue.
I don't really go to malls, and that is the problem. Exactly. All right, we're going to check into this with our own John Gittleson in just a moment. First up,
let's get to Charlie Pellet. Hey there, Charlie.
Well, hello there, and here's what's going on. We've got the Dow, the S&P, and NASDAQ all declining from records. Bond yields jumped after a U.S. debt auction was met with tepid demand in the wake of data showing consumer inflation unexpectedly accelerated in June. The 10-year is now 1.40%. The S&P is down 7, down 0.2%. The Dow lower by 82, down 0.2%. NASDAQ down 15, a drop of 0.1%. The NASDAQ 100 index does remain higher, trading at a record up by 0.2%. At the best level of the day, we did have the Dow up 22 points, up by about 0.1%. Again, the 10-year 1.40%. Gold is down 0.1%, 18.09 the ounce, and West Texas Intermediate crude up 1.6%, 75.27 a barrel. U.S. regulators are adding a warning to Johnson & Johnson's vaccine after a rare immune system disorder was reported in about 100 of the more than 12 million people who received the inoculation. Dr. Amish Adalja is senior scholar at the Johns Hopkins Center for Health Security.
In the United States, the J&J vaccine has sort of lagged because it's been plagued with issues. For example, an 11-day pause after a rare blood clotting disorder was associated with it. A lot of bad headlines about their manufacturing. So it's never been a major component in the U.S. But I do think that this is going to add to vaccine hesitancy in the U.S. with specific to the J&J vaccine. And I think it's unfortunate because when you look at the risk-benefit ratio, this vaccine is still highly favored. And I think it will still be something very important for emerging markets.
Dr. Adalja with the Johns Hopkins Bloomberg School of Public Health, which is supported by Michael R. Bloomberg, founder of Bloomberg LP and Bloomberg Philanthropies. Checking some of the vaccine names that we follow, Pfizer down 0.2%. BioNTech, its German partner, lower by 3.4%. Those are the ADRs. AstraZeneca's ADRs lower, little change, down less than 0.1%. Moderna shares down 1.2%. J&J Johnson & Johnson down 0.1%. Again, recapping, equities are trading lower with the S&P down 8 now, down 0.2%. I'm Charlie Pellet. That is the Bloomberg Business Flash.
Hi, Charlie. Thanks for the update. This story among our most read on the Bloomberg about Barry Sternlicht's investment firm. They're giving up on malls.
Yeah, Starwood Capital Group, they owned 30 malls before the COVID-19 pandemic. It is now down to 8. That is a massive decline.
Yeah, so let's find out what's going on. John Gittleson is with us, real estate and investing reporter at Bloomberg News, on the phone in L.A. Hey, John, nice to have you here with Tim and me. First of all, I mean, Barry Sternlicht's really well known to our audience. I mean, this is a guy who is big time in different types of commercial real estate.
That's right, yeah. I mean, Starwood Hotels, now part of Marriott. Anyway, that was his original, branding opportunity. But yeah, he started out in distressed real estate, and around 2012, he started buying up malls. He thought, I can get a good deal on these and I can make money on them. But basically, the market was changing fast, and then COVID hit and things got even worse. So he got caught basically underwater with a lot of these properties, and rather than pay and try and revive them, it didn't make sense to him. It made more sense, essentially, sell for a loss or walk away.
And look, $2 billion sounds like a lot of money for most things, but this is a relatively small part of Starwood's portfolio, right?
Well, yeah, I mean, about 5% of Starwood's portfolio was in what is known as Starwood Retail Partners. So, I mean, imagine your stock portfolio and you have a bunch of companies that you're like, I'm just going to get rid of them and focus my energy, my resources on other opportunities out there that have more upside. It's a lot of work to deal with these malls. If you want to redevelop them, you take time, patience, skill sets that maybe if I'm Barry Sternlicht, I'd rather be spending my time on something that I can make money on faster.
Is this someone who's cutting their losses before they get worse? Like seeing the writing on the wall? Let me think. What other little phrases, pithy phrases can I say? But you know what I'm saying? Like saying, this is just not a good commercial space anymore. And does it speak to a bigger, larger story here, John?
Well, it's definitely a bigger, larger story. I mean, we've all seen ghost malls have been developing for decades now. And it's accelerated since COVID, since, e-commerce. And since shopping habits changed, like Carol, you were saying earlier, you haven't been to a mall in a while.
No.
Malls were built around department stores, and department stores are like the biggest casualties, of shoppers who can go to Amazon or go to Walmart and all those other kind of things.
But John, I do always wonder, and forgive me, because I do feel like the coasts, especially in New York, we're like, all right, I just shop online constantly. But if I go across the country, and I've been in different states where I'm traveling, and you do go to a mall or you have to go to a store for you shop differently. Is that true the case? I just don't want to be so East Coast centric. Or is it?
I mean,
yeah. Or are they breaking down kind of all over the country?
I would say it's all over the country. I mean, these malls that Barry Sternlicht owns, they're sort of like secondary malls in secondary markets. If you have a good mall, I live in Southern California, in Beverly Hills, in Orange County, in the right parts of the San Francisco Bay Area, Silicon Valley, outside Seattle, those are doing great, and people are still going to them, and they're now eating outside, they're going to movies, they're starting to do all of the other kind of activities on top of buying clothes that you used to do at a mall. But there are so many malls in the United States. We are over-stored, over-retailed compared to everywhere else on Earth. And then there are places that are really easy to get to. I mean, a Walmart or a Target is like a mall in one place for a lot of people. And they're really, discount, good prices, and easy in, easy out.
Hey, John, just in the last 30 seconds we have with you, who's buying these malls and what are they doing with them?
Well, basically, people who are getting them at very low cost. And it really depends on the location. You can take out a department store, turn it into an apartment. You can turn it into maybe an office. You could turn it into a medical office or a school. Or you could turn it into a sort of last mile distribution place. But you have to get the cost of the property down and an owner who has patient money so that they can take time, because it takes a long time to get all the approvals that are involved with repurposing a mall like this.
Right. It's not so easy to just make a quick switch. What are you thinking?
Yeah, it's just like such a small portion of the portfolio. It's crazy.
Yeah, and I do think there's something to be like top tier versus secondary tier. I think that's a good point that John made. John Gittleson, thank you so much. Real estate and investing reporter at Bloomberg News from LA. Join him on Twitter at John Gitt.
Well, let's get a check of the latest world and national news with Nancy Lyons in D.C. Hey there, Nancy.
Hey, Tim. President Biden is in Philadelphia, where he soon will be laying out the moral case for voting rights as he faces growing pressure from civil rights activists and other Democrats to combat efforts by Republican-led state legislatures to restrict access to the ballot. Biden has declared protecting voting rights was the central cause of his presidency, but the White House has taken sharp criticism from allies for not doing enough. Biden's speech is being delivered from the National Constitution Center and is intended as the opening salvo of a public pressure campaign. Well, Texas Democrats who broke quorum and traveled to Washington, D.C. can expect a visit from law enforcement. They left the state to once again block passage of sweeping new voting restrictions. The Texas House voted today in support of a plan that involves having the Sergeant at Arms try to get all the missing members back, even if it's through an arrest warrant. Marijuana legislation is about to be placed on Senate Democrats' agenda. Bloomberg's Nathan Hager reports.
Senate Majority Leader Chuck Schumer, Finance Chairman Ron Wyden, and New Jersey Democrat Cory Booker are expected to unveil a draft bill tomorrow. A source tells Bloomberg it'll be called the Cannabis Administration and Opportunity Act. The legislation would reportedly remove marijuana from the federal list of controlled substances and allow it to be taxed and regulated on the federal level while letting states continue enforcing their own pot laws. Schumer has said he hopes to legalize marijuana by next April 20th. That is a date that is popular with marijuana enthusiasts. In Washington, I'm Nathan Hager, Bloomberg Radio.
Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries.
All right, Nance, thank you so much. Got a couple of PE guys we want to talk to you about. Josh Harris, the co-founder of Apollo Global Management, you know him, who was passed over for the top job at the private equity powerhouse earlier this year. Lots of things going on at Apollo. We know that. He apparently laying the groundwork to raise his own fund. He helped found Apollo back in 1990 with Leon Black and Mark Rowan. Well, he's met with recruiting firms, Tim, to help him start building a team, according to those in the know.
Yeah, the fund will focus, Carol, on middle market private equity deals and has a loose target of $5 billion. Harris is 56 years old. He's striking out on his own. Remember, he announced back in May that he would be relinquishing those day-to-day responsibilities at Apollo. And the timing for this new fund, it may be pretty good because private equity funds, well, they gathered $514 billion during the first half of the year. That's a 70% jump from the same period in 2020. That's according to prequindata.opu.
What's cool about Josh Harris is look for him to make maybe sports investments because his first of all, he's worth about $7 billion according to the Bloomberg Billionaires Index. His family offices manages his personal fortune, and that includes stakes in the NBA's Philadelphia 76ers, the NHL's New Jersey Devils, and so we'll see what he does going forward. The other thing is David Tepper.
Yeah, let's talk David Tepper, the hedge fund manager. He's best known for his stock-picking prowess. He's devoting a piece of his personal fortune to private investing.
Yeah, he's right. Tepper has become the founding investor for a private equity firm that plans to invest in growth companies, special situations, and the media and sports sectors, according to regulatory filings and a person familiar with the matter. So it's sports.
It's huge right now.
Well, it's like that content that increasingly is growing. We saw the success of ESPN. We've seen others get into it. We've seen new leagues started. And especially as you have more streaming and outlets, people are looking for content. And sports is one of those things. It's like it's destination viewing. It's right. You have to go at a certain time typically.
Yeah, you can't watch it. You can't watch it later. And
I mean,
of course,
you can, but it's not that much fun.
Right, and the marketers want to reach those people who are attracted to that content.
All right, something we're watching these guys. This is Bloomberg.
news, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
Bloomberg World Headquarters, I'm Charlie Pellet. Stocks and bonds are falling as the inflation debate intensifies. We're very close to the worst level of the day right now on the S&P. Down 12, down by about 0.3%. The Dow's down 108, down 0.3%. NASDAQ down 44, also down 0.3%. Bottom line, here's stocks are retreating from records. Bond yields rose as investors debate whether the Federal Reserve risks letting inflation get out of hand. 10-year yield 1.41%. Gold is up $2 the ounce, higher, little changed, up by about 0.1% at 18.08. And West Texas Intermediate crude up 1.5%, 75.22 a barrel. After earnings, J.P. Morgan Chase down 1.5%. Goldman Sachs down 1%. Tomorrow morning, we'll be hearing from the likes of Citigroup, Wells Fargo, and Bank of America. Italy is banning huge cruise ships from sailing into Venice, declaring the city's waterways, quote, a national monument. Before the coronavirus pandemic severely curtailed international travel, cruise ships discharging thousands of day trippers overwhelm Venice and its delicate marine environment. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you. We are highlighting another one of our most read stories on the Bloomberg today. This one about the NFL player turned lawmaker that was a rising star in the Republican Party, Tim, until he wasn't. It's in the upcoming issue of the magazine.
It's written by Josh Green, national correspondent for Bloomberg Business Week. Joel Weber is joining us as well, editor for Bloomberg Business Week. He's with us in the Interactive Broker studio in New York. Josh is joining us on the phone from Washington, D.C. Who is Anthony Gonzalez, and why isn't he a national name?
Well, he is a national name, I think, and I guess it depends.
Well, I guess in the vein of Liz Cheney, I guess I would say.
Well, he's actually kind of purposely kept his profile slightly lower, I think, than Cheney did, and Cheney obviously was like a pretty prominent position in the GOP. But I think what's really interesting about Josh's story is there were people pre-January 6th who really kind of looked like the future of the GOP, right? And Gonzalez was one of those. And now he finds himself in a very difficult role of being a kind of once future leader of GOP, potentially a rising star, but mired by what has become from the Trump supporting GOP. Mm-hmm. And Josh, let's bring you in a little bit to talk about that. What has been his tactic to date, and how does that put him with his constituents?
I mean, what's fascinating about Gonzalez is that he embodies everything the Republican Party has wanted itself to be for the last 25 years. He's young. He's the son of a Cuban immigrant. He was a first-round draft pick of the Indianapolis Colts. He's got a business school degree. Serious, young, hip, all that kind of stuff. Clearly marked as a rising star. And then Trump came along, and Gonzalez became one of the 10 people who voted to impeach him. And practically overnight, that sort of eclipsed everything else there is about Anthony Gonzalez. And the reason I picked this race, as somebody said earlier, he's not as prominent as Liz Cheney, who also voted to impeach Trump and has made that the entire centerpiece of her political life. He's just a guy who voted on his conscience, voted to impeach Trump, but is still a conservative congressman with what he thinks is a successful record. So what it sets up is this wonderful test case. It's almost like a laboratory experiment in whether a serious Republican conservative can get reelected after voting for Donald Trump. And what's so interesting about this is that it's not just Republicans, but Democrats, too, are fascinated by this race because we think it's going to be a sort of a gauge about how strong Trump's influence continues to be. One of my consultants, I quote in piece, likened it to Groundhog Day. That if the Trump challenger to Gonzalez's wins, then we know it's going to be another season of Trump dominating Republican Party. But if Gonzalez manages to hold on to his seat, then maybe spring has arrived and we've begun to move beyond Donald Trump.
And who's he going to be in a showdown with? Who's the other faces?
So his main challenger is a guy named Max Miller, who is a former Trump aide. from the local area, immediately won Trump's endorsement as soon as he jumped in the race, because Trump, as we all know, revels in punishing his enemies, especially Republicans, and has gone after Gonzalez with a vengeance. His first big rally, Trump's post-election at the end of June, he flew to Ohio right outside Gonzalez's district to trash him and tell Republicans to vote against him. So that's a bit of a millstone if you're a Republican congressman running for re-election, but that's what Gonzalez has to deal with.
I love that you write in your story that Gonzalez, appears to have a healthy relationship with his own political mortality. So he understands he's a football player. Sometimes you win, sometimes you lose. Sometimes you're going to play and be a star player, and sometimes you're going to have another career after it. Tell us a little bit about his kind of approach.
Yeah, well, I mean, what's been so, I think, disconcerting to a lot of, Republicans and just sort of Americans generally, I think, is the number of Republicans who've kind of truckled to Trump and gone along with, whatever the conspiracy theory or lie is that he's sort of pushing. One name that gets mentioned a lot is South Carolina Senator Lindsey Graham, who sort of reinvents himself according to whatever politics necessitates. And Gonzalez is adamant that he's not going to do that. And I think the impeachment vote backs that up. But as he put it to me, I mean, he was a first-round draft pick with a great NFL career going. He tore up his knee. That career ended abruptly, but he was able to reinvent himself, went to business school, got elected as a congressman. So he doesn't fear his own political mortality in quite the way I think a lot of other politicians do. And that makes him interesting because he's willing to kind of speak the truth, stand up for what he believes in, and let the chips fall where they may.
You also make the point, Josh, that he's set out to do, and he's actually getting done exactly what he set out to do, from infrastructure to COVID relief to vaccines. And also, he's had a pretty good couple of quarters of fundraising, so he's been pretty successful thus far.
Yeah, I mean, the other fascinating thing about this is, like, back in the times before Trump, congressmen used to get measured for re-election on, hey, did you do what you campaigned on? And said you had set out to do. The two big components of Gonzalez's last race were, he said, look, we want to produce vaccine and distribute it to everybody who wants it. That's obviously happening now. And I want to push for a big bipartisan infrastructure bill. And a couple weeks ago, Biden came out and announced a big bipartisan infrastructure agreement that Gonzalez had a hand in negotiating. So, by the old measure of whether or not you're an effective congressman, Gonzalez has a really good case to make. And he is a believer. Not everybody is, but he is a believer that will still count for something with the Republican voters when primary time comes next spring.
So next spring still feels like a long way away. When are we going to start to get a sense of what even the polls might suggest in this case study, Josh?
I don't think we're going to know for a long time. I mean, by the early measures, Gonzalez is doing okay. I mean, his favorability ratings are strong. As you mentioned, he's had 2 quarters of very strong fundraising, but he also has the loudest, most important voice in the Republican Party, Donald Trump's, going against him. So I think part of it will depend, is Trump as powerful and influence, 9 months from now as he is today? If so, I think Gonzalez is going to have a tough time getting reelected. But a lot can happen between now and then, and Gonzalez has enough money to make a good case for himself publicly. So, we're going to get just what I said we're going to get in this piece, which is a measure of Trump's effectiveness. And I think that's why everybody in the country is going to be looking at this race come next spring.
Yeah, I did also think, as you pointed out, that he's had some strong fundraising, kind of the strongest than he's ever seen, and maybe it's an early indication. Hey, Josh, thank you so much. Josh Green, national correspondent at Bloomberg Business Week, on the phone from Washington, D.C. Joel, do you have a last thought?
Well, I'm also, this is one of many races where there were people who voted again for impeachment, and I just am also going to be very curious to what happens in all those other districts. And do they go one way, or is it like half and half or something?
Yeah, it'll be really telling in terms of what it means for.
Yeah, and how much does Trump hit the road ahead of that too?
Yeah, well, I'm guessing a lot.
Yeah, I am too.
All right. We got to run. Joel, thanks. For those of you listening in New York, D.C., and San Francisco, watching on YouTube, Business Week, we're going to continue. If you're listening on Bloomberg 106.1 in Boston, B-State Business is next.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
Bloomberg World Headquarters, I'm Charlie Pellet. We move into the final hour of trading on this Tuesday, July 13th, a bank earnings Tuesday. JP Morgan Chase, Goldman Sachs out this morning. They're both lower. Stocks right now lower across the board. We're off session lows, but it is a down day. S&P retreating from a record down 8 right now, down by about 0.2%. Stocks decline. Bond yields rose as investors debate whether the Federal Reserve risks letting inflation get out of hand. 10-year yield, 1.41% right now. 10-year down 14.30 seconds. The Dow is down 84, down 0.2%. Had spent most of the morning higher. NASDAQ down 20, a drop of 0.1%. But the NASDAQ 100 index is up 0.2%, on track for a record. Gold up 0.1%, 18.07 the ounce. West Texas Intermediate crude up 1.5%, 75.22 a barrel. JP Morgan Chase's investment bankers posted their best quarter ever as a record first half in deal making bolstered the bottom line. And Goldman Sachs's investment bankers stitched together deals at a busy pace in the second quarter, softening the blow of a post-pandemic trading slowdown and helping earnings beat analyst expectations. As for the bank group, Anastasia Amoroso is chief investment strategist at iCapital Network.
I think some of the strength in the consumer that we're seeing and the credit card spending data, that's going to start to shift to the business sector. Part of the really weak spot in loan growth for the banks is actually the commercial and industrial loan growth. It has just not been there. But as the economy comes back online, as the CEOs, CFOs are increasingly comfortable with where things are, they're going to start to boost their CapEx plans, and that's going to need to require some loans and financing.
JP Morgan Chase down 1.4%. Goldman Sachs down 0.8%. Also out with earnings today, PepsiCo shares up by 2.3%. S&P down 0.2%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Oh.
You're listening to Bloomberg Business Week with Carol Messer and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
Oh, to be a fly on the wall. I couldn't wait to get to our next guest.
This is what's so great about having everyone come back to work. We can talk during the breaks.
I love it.
Yeah.
All right, so let's get to it. She is in our studio with Tim and myself. It's one of our most read stories about those that are speaking out, pushing for more aggressive government policies to address societal problems. Let's get more on the ex-ESG insiders who are dissing and dismissing corporate green goals as hype. On this story, Bloomberg News ESG reporter Sejal Kashan, she is with us in our Interactive Brokers studio. I do love this story. So tell us about the individual, Tariq Fancy.
Yeah, well, he was, in the heart of the beast, so to speak. He's at BlackRock, the world's biggest money manager. Yeah.
Huge.
And as you remember last year, Larry Fink came out and said he was going to put climate at the center of its investments, its investment strategy. Tariq was actually there. He actually left before BlackRock really ramped up. But he talked about his experiences, and it wasn't so much about being at BlackRock. His experiences were more broadly directed at the sort of the sustainable investing world. And he talked about how it's great having all these low carbon funds, these climate friendly funds, ESG ETFs, exchange traded funds, but they're not really enough to move the needle when we're dealing with the climate crisis.
Because it is a crisis.
That's what the scientists are saying. Yeah.
So what more needs to be done? I mean, what are these ex-ESG insiders saying isn't going far enough?
Yeah, I mean, look, they all say corporate sustainability efforts have been good. It's not like, it's been a waste of time. But there needs to be more aggressive government policy.
Okay, so I'm glad you brought that up, because when I read your piece, I was again reminded of the lofty goals that we hear from companies. And these are companies that say, okay, in 3 decades, we will be carbon neutral or net zero emissions. And I'm thinking to myself, okay, is anyone listening to this right now or involved in what they're saying going to be involved in this company 3 decades from now? Like, these are goals that are so far away.
No, absolutely, and I think that's. I mean, look what we've seen just this year or just even last week or the week before with the heats in the Northwest and Texas earlier this year. like this is we're seeing the effects of climate change as we speak. This is not something that's going to happen in 50 years' time. We're already there.
Well, because we have the Sustainable Business Summit Global going on right now by Bloomberg. It's a couple of days of programming. We'll hear a little bit of my conversation with the CFO of AB InBev and also the Chief Sustainability Officer. And, we talked about this, and I think they would agree that it's not perfect, but it's a journey. But I think what you're saying to me is, there's those slow, meandering walks that we take through the park. And then there's like, I got to get to work.
Yeah.
Bam.
Yeah.
That's where we are. From what you're hearing is that we need to be more aggressive about the steps.
Exactly. I mean, this is what all of these executives or former executives have said, is that, we're in a crisis mode. So, yeah, all of these efforts, they're great. All the corporate sustainability efforts are good. But we are in a climate crisis. So they're saying that the government needs to come in and implement things like carbon taxes and the like, and more aggressive ones.
Some more penalties to some, right? And punitive actions that if you don't abide more quickly, right, you're going to pay.
Unfortunately, but we are so entangled with the fossil fuel industry using, our existence is all, fueling emissions. So we really need to sort of change things around if we're going to meet any of these targets that companies are setting.
Someone you spoke to said the problem with greenwashing is green wishing. What does that mean?
That's a great quote.
Yeah. So he used to work, Duncan Austin used to work at Al Gore's investment firm. And, there's always this talk about greenwashing, which is where companies or groups are exaggerating their environmental sort of credentials. But he's saying green wishing, thinking that we're doing better than what we really are, is even more harmful because it's this sort of false sense of sort of security.
Mm-hmm. Well, it's interesting. I do feel like the EU is leading the way, especially with the government involvement, and they are putting metrics and money to that. Is that the model, but just a more aggressive form of what? What is? I'm always caught up in the specifics of what more we need to do to make it different.
I'm on the same page as you on that one. I mean, look, there are lots of things going on. I mean, the SEC is looking at a raft of, potential moves, and there's debates going on, and it'd be anything from disclosing things like ESG metrics.
And that's part of the problem, right? I know even the AB InBev guys are the metrics between when you're defining E or S or G, some of them are easier than others.
Absolutely. The S seems to be the sort of the sticking point where there's just a lack of data compared with the E, where there is emissions data or water usage data and the like. So it's a work in motion.
Yeah.
We hear from companies that have ESG products that investors are demanding these. What do we know about actual investor demand for products that provide more than just a return?
Yeah, no, absolutely. I mean, we've got the country's biggest pension plans like CalSTRS, CalPERS, New York City, New York State, who are really ramping up. Yeah, because they've set their own net zero goals, at least on the East Coast here. So it's all in line of sort of divesting, ramping up, and putting sort of channeling capital to sort of cleaner technologies and the like. That's going to help us all meet these goals.
But ESG investing, I mean, this is part of the problem. You can have a company that's working on it, but is still really hurting the environment. But people say you can be in the ESG fund because you're working on it. So as an investor, it's wait a minute, is really my money going to support, the better end,
Absolutely.
better outcome?
I mean, what somebody has said to me, it's really difficult to be a purist here. We're all entangled in this. So it is a work in motion, unfortunately.
Which government is most aggressive right now?
I mean, well, the EU, as Carol said, they are way ahead. But I mean, the US is fast catching up, and again, it's a geopolitical thing as well. Who wants to own this space? Who wants to own clean technologies? Who wants to be sort of at the forefront of this sort of transition to a low carbon existence?
But if the pandemic taught us anything, it's just a reminder that things like a health crisis or things like climate change really know no borders. So if we don't figure out something globally, the situation, it's already very difficult for certain parts of the world. I love this story. It's a most read, and I'll be bringing it up with some of my panels at the Sustainable Business Summit. Sejal, thank you.
Thank you.
Really appreciate you coming by. Sejal Kishan, she is ESG reporter at Bloomberg News in our Bloomberg Interactive broker studio.
Yeah, a great piece. Check it out at Bloomberg.com and on the terminal.
I'm somebody who likes metrics, and how do you, measure something? And I think it's really tricky right now.
We don't know.
We don't know. It's not exact. Let's get to World and National News. For that, it's over to Nancy Lyons in D.C. Hey, Nance.
Hey, Carol. President Biden is in Philadelphia, where he says, "We the people began." He's making the case for broader access to voting.
Some things in America should be simple and straightforward. Perhaps the most important of those things, the most fundamental of those things, is the right to vote. The right to vote freely.
Biden is speaking at the National Constitution Center. He says the 2020 election was the most scrutinized in history, and he adds that the big lie spread by Republicans is just that, a lie. His speech comes as Democratic state lawmakers from Texas take a stand against voting legislation that's making its way through their state legislature. They flew to Washington, essentially preventing a quorum and blocking passage of the bills. Their Republican colleagues are authorizing law enforcement to find and bring them back under warrant of arrest if necessary. Well, the White House is enlisting pop star Olivia Rodrigo to make the case that vaccines are good for you, which is the title of her hit song. While in Washington tomorrow, Rodrigo will meet with President Biden as well as Dr. Anthony Fauci. She'll also record videos to encourage young people to be vaccinated. The CDC says in April, just 52% of unvaccinated adolescents aged 13 to 17 said they intended to get the vaccine. And the Emmy nominations are out. The Crown and The Mandalorian are the top nominees with 24 nods each. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons.
I'm just pumped from that.
You are. Well, you're also doing this great panel.
Well, you know, I do think about sustainability, and I think about the Sustainable Business Summit that we're doing right now. And there are companies who are taking lots of steps, have been for years, and each of those steps do help. But it is interesting when Sejal talks about that we're in a crisis, and it's like my arm just fell off. I don't have time to get to that. Like, I've got to quickly fix it and get it back on or something versus, I mean, it's just a sense of urgency.
And one challenge I think that a lot of these companies face is that Wall Street is so interested in the short term, as we see with reactions.
And maybe that's where investors, and we're not good with this stuff.
Yeah.
In the meantime, a great read. I believe is this our Bloomberg Big Take?
This is the Big Take.
And it's about Bitcoin miners fleeing China in a global scramble for electric power. We've talked about this in different ways over the last few months.
Yeah, crypto crackdown has sent them in search of cheaper, greener power sources. So the story opens thinking back to one weekend in June. I encourage everybody to check this out. When hundreds of gloomy Bitcoin miners crowded into a luxury hotel in Western China, here's the problem they had. Just weeks earlier, the Chinese government banned cryptocurrency mining over concerns about illicit coal mining and underlying financial risks. Now they had to figure out how to move millions of computers, Carol, out of the country.
And this is going to be one of the big issues, I think, going forward. We've talked with Kathy Wood about this. Elon Musk has addressed it. He liked Bitcoin, right? And then he kind of backed off because of the energy impact. I mean, here he is, Solar City, and thinking about the impact on the environment. We've talked with Kathy, and she believes that ultimately as solar power and alternative forms of power get cheaper, right, that mining of cryptocurrencies will also come down.
There are also American companies, American Bitcoin mining companies, that think that they can take some of what China has banned and use the United States as an attractive place to actually do this and attract these Bitcoin miners and try to figure out innovative ways to use energy and use the power grid to make it more sustainable.
And this is what happens. How many times have we said it? When you've got a situation, you've got a problem, you've got something that's going to be probably a bigger part of our society. All of our guys tell us that. And you've got to figure out a way to do it without so much harm maybe to society or the environment.
And can they figure it out before Bitcoin gets displaced by something else?
Exactly. So anyways, check it out at Bloomberg.com. This is Bloomberg Radio.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. Bank earnings Tuesday. Stocks and bonds are falling as the inflation debate intensifies. Right now, the S&P at the worst level of the day. Let's head right over to the first word breaking news desk for today's afternoon call. Here he is, Bill Maloney.
And good afternoon, Charlie. U.S. stocks trading lower amid a spike in yields after the 1 o'clock auction. Dow's currently down 100 points. S&P's are up 15, and NASDAQ declines by 42. The U.S. 10-year yield hits 1.41%. Gold is little change. Bitcoin is down 1%, and transports fall 92. Among the main 11 S&P sectors, only tech, consumer staples, and telecom were in the green. Real estate and materials were under pressure. And leaders to the upside in the Dow, Visa, and Microsoft, while Boeing fell 3.8% and led to the downside. After earnings, Pepsi rose 2.4% to a record, while J.P. Morgan and Goldman Sachs each fell after their earnings. In other news, Apple and Goldman Sachs plan a buy now, pay later service, and Square plans a new payment terminal with built-in tap to pay. Wrapping things up, Chipotle hit a record intraday high. Live from the First Breaking News Desk, I'm Bill Maloney. Charlie.
Okay, we thank you very much, Bill. And to hear live breaking news over your Bloomberg type squawk, SQUAWK on your terminal. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. So earlier today, I caught up with AB InBev CFO Fernando Tenenbaum and the head of sustainability, Ezgi Barcenas, from the Bloomberg Sustainable Business Summit. And we talked about a lot, and in particular, that record $10.1 billion sustainability-linked loan that they did earlier this year. In this excerpt, though, they both shared their optimistic outlook and news about that deal. Check it out.
It's been a very interesting period for us. Probably if you go back like March and April last year, it was a period of a lot of uncertainty, but it's fair to say since May, the business has been quite strong, a lot of momentum, very good underlying demand, and the momentum has been kept throughout the second half of last year. And so far, we continue to be excited about the prospects going forward.
So it sounds like we were drinking a lot during the pandemic, and we're continuing to do that post-pandemic?
Yes, beer continued to be quite strong. So people love beer and continue to love beer before and after the pandemic.
Hear, hear. Ezgi, come on in on this, because one of the things that we talked about a lot during the pandemic is sustainability and also supply chains, right? The difficulties. How is it looking for you guys? Are you able to keep up with demand and get what you need?
Yeah, thanks for having us today, Carol. And absolutely, you know, as Fernando said, last year we really focused on supporting frontline workers as well as our supply chain, our communities and customers. And, you know, we provided over 3 million bottles of hand sanitizers, 3 million face shields. We helped build 6 healthcare facilities around the world from Brazil to Mexico. And, you know, we were able to remotely support our farmers as well and really kept the buying centers open so that we can ensure that farmer cash flow and supply security. So, you know, we're geared for a fast recovery, and we see that around the world.
But in terms of your supply chain, what you need, Ezgi, you get what you want, you're able to access it, and maybe at a higher cost, maybe not?
Yeah, absolutely. You know, for a global company, we're really able to leverage our local networks around the world. So the teams on the ground, our supply chain teams, procurement teams have been working nonstop throughout the pandemic. And yes, this is about resilience for us and business continuity as much as it is about our, you know, community resilience as well. So definitely onto a fast recovery.
All right, well, it's good to hear optimism. And I got to tell you, you guys all caught our attention earlier this year when you did that record debt deal, a $10.1 billion debt facility. It was a sustainability-linked loan, the largest ever. And it's in a year where we're seeing a lot more momentum on this front. The ethical debt market now worth over $3 trillion. I'm going to cut to the chase. Whose idea was it? How did this kind of come to be at AB InBev?
Carol, it was actually a natural process, because sustainability has been part of our company kind of forever. I remember when I joined ABI 17 years ago, I was visiting the plants and I was talking to the plant manager, and he was really excited. He was reducing water consumption. And then I would talk to another person on the plant, and they were very excited. They were out of our waste, they were using like 97%. And I would come back year after year, and these numbers were always improving. Then it became 98%, then 99, and then we're talking 99 point whatever. So it kind of it's part of our DNA, even before the word sustainability was out there, and it was really important. So it was always with us. On the other hand, after some years, we start seeing more and more noise, or more good noise on the financial markets about sustainability, but it was not very clear what it is, what it was, and what it could qualify as sustainability or not. So even though we were doing a lot of work internally, we're not necessarily comfortable to be behind some of these instruments before the market was mature enough. So at the beginning of this year, we felt the moment was right. We felt that the moment was right for us to be behind this instrument. But having said that, there is still a lot to go. The market is maturing, but there is still a lot of progress made. There is still a lot of improvements. But we definitely feel that now we have momentum, and now we felt that given our size and our scale, we need to be on the forefront of these initiatives.
Well, it definitely pushes the needle. Ezgi, come on in on this conversation. What were some of the conversations? I'm always curious about the back and forth between strategy type individuals, senior executives like yourself, and the financial side of the house, which is increasingly involved in strategy.
Yeah, it really happened very naturally, I would say. And I will even give the credit to Fernando's team, because it was them that approached us, that said, you guys are doing a lot of great work. We are looking into renewing our revolving credit facility. How do we move forward, and really understanding what the sustainable finance options are out there. So it was really the natural evolution for us. I always like to say that sustainability is the ultimate design brief, right? So that's how we design our business. These for us are really good operating practices, just to create that resilience across our business. So it was really a no-brainer to think about, here are the KPIs that we track and monitor over time. Why not really reinforce that message internally and externally as well, and continue to learn from the developments in the market. I really am encouraged as a sustainability professional to see how the pandemic has accentuated the materiality of ESG, and I think this is just the beginning. And this really will allow the companies to put on a long-term hat and really think about resilience into the future.
That last voice, Ezgi Barcenas. She's the Global Vice President, Chief Sustainability Officer over at AB InBev, joining, of course, Fernando Tenenbaum, who's the Chief Financial Officer at AB InBev. And if you want to hear that full conversation, check it out, and more interviews from the Bloomberg Sustainable Business Summit Global. You can find that at BloombergLive.com, and it really fits into the conversation we just had with Sejal.
Yeah, investors thinking about it, but companies thinking about it, and critics still saying, though, companies not doing enough.
And governments need to provide, kind of more incentives or more punitive actions. You are listening to Bloomberg Business Week Chart of the Day, coming up.
Broadcasting live from the Bloomberg Interactive Broker Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 106.1 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
It's that time.
Dun, da, da, da.
Song of the day. Is that the song of the day?
No.
Okay.
What song is that?
Dave is just looking at me in disgust right
Was there
now.
an L? Was there a
Yeah.
Was there a little lame move? Lame master.
No, he was looking at me.
Are we gonna be able to get this one? Okay, he thinks so.
Oh, okay.
I'm hopeful. All right, let's get another check on the trading day. We've just got a little bit under half an hour to go here, Charlie Pellet.
And absolutely right about that. 28 minutes to be precise. The Dow, the S&P, NASDAQ, all moving lower. Red on the screen. NASDAQ 100 index just turning lower right now, retreating from a record. Stocks dropping, bond yields rising as investors debate whether the Fed risks letting inflation get out of hand. We've got the 10-year yield now 1.41%. 10-year down 14.30 seconds. S&P down 16, drop of 0.4%. Just about the worst level of the day on the S&P right now, down 0.4%. The Dow down 105, lower by 0.3%. NASDAQ lower by 51, down by 0.4%. Keep in mind, in the early going, the Dow, the S&P, NASDAQ had all been higher. Bank earnings out this morning. J.P. Morgan Chase down 1.3%. Goldman Sachs down 0.9%. Gold is up $1 the ounce, higher by 0.1%. West Texas Intermediate crude up 1.6%, $75.28 a barrel. Regulators are adding a warning to Johnson & Johnson's vaccine after a rare immune system disorder was reported in about 100 of the more than 12 million people who received the inoculation. J&J shares little change, down 7 cents right now. Dr. Amish Adalja is senior scholar at the Johns Hopkins Center for Health Security, and he says you've got to keep the risk-reward for the vaccine in perspective.
The fact that it's one shot, the fact that it doesn't require extreme cold storage still makes it a very attractive vaccine. And I think what we have to do is really teach people about how to make risk-benefit calculations. And we're talking about 100 cases and over 21 million doses given. This is a very rare type of thing. And I think it's important that people be aware of it. And it's definitely important for clinicians to be on the lookout for this rare side effect when it does occur.
Dr. Adalja with the Johns Hopkins Bloomberg School of Public Health, which is supported by Michael R. Bloomberg, founder of Bloomberg LP and Bloomberg Philanthropies. Pfizer shares down 0.2%. Its German partner BioNTech down 2.92%. ADRs of AstraZeneca, they're up right now by about 0.1%. Moderna down 1.2%. J&J again, little change, down less than 0.1%. Recapping 10-year yield 1.41%. S&P retreating from a record low of the day now, down 0.4%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Thank you so much, Charlie Pellet. This is Bloomberg.
If I had ever been in before, I would probably know just what to do. Don't you?
I was going to do the Don't You, but they're so perfect. Nobody does harmony like CSNY. Crosby, Stills, Nash. It's all of them, right?
Right. You are correct.
What's the song now? Wait. What's the song?
Look at the chart, and you should be able to figure it out. Tim, you can play too.
I know. I was just going to tell you I saw David Crosby once getting tacos in California.
Did you really?
I did, yeah.
Did you go up to him?
No.
Oh.
No.
Okay.
Should I have?
I don't know. I
Yeah,
guess
in
probably.
Santa Barbara.
Depends on when you saw him.
It was years ago.
Depends on how many years ago.
Legendary taco place in Santa Barbara, California called La Superica. David Crosby was there getting tacos. I was with my dad, and he said, "Do you know who that is?" And I said, "No."
Ouch.
So he had to tell me.
Nothing ever changes.
Yeah, exactly.
There you go.
Tech stocks you're talking about.
Yeah, but the chart headline says Deja Vu. That's the song, title track from the album, which among other things had their version of Woodstock and Teach Your Children.
Deja Vu is like the classic, right? Is that
Absolutely.
the album? Yeah.
1970, the first album with Crosby, Stills, Nash, and Young.
Right? Nobody does harmonies like they do.
Yeah, absolutely.
All right, so Deja Vu all over again. So tell us about your chart.
Well, that's a whole nother song, but we'll spare that
Isn't
for
that
later.
Yogi Berra?
No, actually, that's John Fogerty.
Okay.
But I digress. I mean, the real issue is
oh my God.
valuation for tech stocks.
Okay.
I mean, and it's something that Morgan Stanley Wealth Management pointed out. You know, we're kind of getting back to where we were in the dot-com era, at least in their view. And there's a particular indicator they looked at. It's what's called a forward price to sales ratio. So in other words, you take revenue estimates for the next 12 months and then, look at where the index is and you come up with a number. Now you go back to March 2000, which was really the peak of the dot-com era, and you saw that indicator get up to about 7.5. And you know where we are now? About 7.5. In fact, as of yesterday, it was less than 0.3% away from breaking the record. And I am tracking this indicator today because tech stocks are higher. And that means it looks like the record is going to be broken. So it's an issue for the folks at Morgan Stanley Wealth Management just because it shows you how expensive these stocks are. And they have a number of concerns about where tech companies are headed. Competitive issues, higher taxes, stricter regulations, among other things. In their view, and I'm quoting their phrase, unprecedented headwinds for a lot of these tech companies. So if you want to know more, folks, send me an email. I'll get you the chart, the explanation that goes with it, and everything I do going forward. The email address is dwilson@bloomberg.net. That's dwilson@bloomberg.net.
Dave, that's a little scary, I think, to a lot of people.
Yeah, it certainly scares these folks.
See, well, go. What?
Lisa Showett and her colleagues at Morgan Stanley Wealth Management, because, one thing I will say, though, I've gotten a couple of reader emails or listener emails about this, and they're pointing out, tech companies in 2000 are not tech companies.
I know what you were going to say. I knew you were going to say that. And they are profitable now, and they weren't profitable then.
They're massive. They're such a big part of our economy. They're such a big part of our market, and they're also where you tend to see growth.
You're still talking historically high valuations. And we should point out, just for the record, that the S&P 500 has been above its forward price to sales peak from March 2000 for 3.5 years. At least that's when it first rose above it. And now it's something like 30% higher.
I know we need to get to your stock of the day, but isn't it kind of a bet on where you think the economy is going? What does our economy increasingly continue to be? And if it's a tech-related type of economy, then maybe some of this makes sense.
Yeah, maybe. Of course, you have to wonder what's ahead for tech companies. Think about, all the efforts being made in Washington to kind of rein them in terms of their business. If the U.S. gets like China at all, that's something to be concerned about.
Oh, they're not going to, though.
That'd be a stretch, though.
Well, it'd be a stretch at how far they go.
Right.
Nonetheless, let us turn.
Okay, let's turn to the stock
of the day. It's Vox International. That's 2 X's. And the ticker is the same as the first name, VOXX. We're talking about home and auto electronics. AudioVox may be a familiar name.
Right.
Well, they came out with quarterly results. They were all right, but it was the question of what happens going forward. They're looking at raising prices, but they don't expect that, to offset their cost increases anytime soon. And the stock is down 15.5%, headed for its biggest loss since March of last year.
Look for Dave's Stock of the Day just after 4:15 p.m. Wall Street time on Facebook, LinkedIn, and on Twitter at One Dave.
You're like one of those auction guys.
You got to get to world and national news with Nancy Lyons in D.C. Hey there, Nance.
Hey, President Biden says voting rights are being threatened all across the country, saying the 21st century Jim Crow assault is real. He spoke today at the National Constitution Center in Philadelphia.
There's an unfolding assault taking place in America today, an attempt to suppress and subvert the right to vote in fair and free elections, an assault on democracy, an assault on liberty, an assault on who we are.
The president says Congress must pass legislation which keeps voting fair for all Americans. The White House is also pressing ahead with its clean energy proposals in the infrastructure bills working their way through Congress and via executive orders.
The major car makers haven't needed government prodding to switch to electric vehicles. White House climate advisor Gina McCarthy said in a Bloomberg interview.
They're going to invest in electric vehicles because that's where it's at. The bigger effort is to make sure that we grab the supply chain back here in the United States. So we're manufacturing the parts, we're manufacturing the batteries, and we're bringing the jobs back home that were offshored.
McCarthy noted that the government will be replacing its fleet with electric vehicles, and every department is looking to reduce its impact on global warming. In Washington, Irv Chapman, Bloomberg Radio.
Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons. This is Bloomberg.
All right, Nance, thank you so much. So I want to bring you a story. It's among our most read on the Bloomberg terminal, if not the most read. It's a Bloomberg exclusive. It crossed about 2:30 Wall Street time. Apple working on a new service that's going to let consumers pay for any Apple Pay purchase in installments over time, rivaling the buy now, pay later offerings popularized by services. You know who they are, Affirm Holdings, also PayPal Holdings.
Yeah, the upcoming service known internally as Apple Pay Later, it's going to use Goldman Sachs as the lender for the loans needed for the installment offerings. That's according to people with knowledge of the matter. Goldman Sachs has been Apple's partner, remember, for the Apple credit card since 2019, but this new offering is not tied to the Apple card and it doesn't require the use of one. That's according to the people who asked not to be named discussing unannounced products. Carol, a couple things come to mind with this. It's not just Affirm and PayPal, it's also Klarna. In Europe, it's, I think, Europe's biggest startup right now in terms of the market cap, the private valuation. The other thing is that Apple products have become so expensive that in order for many people to afford them, they are either putting them on a credit card or they want to use services that allow them to pay in installments. And they're traditionally, to pay for phones, you were able to do that.
Right.
But the model shifted in recent years where you're paying, you can still pay if you buy it through like a Verizon or an AT&T, for example, but not necessarily if you buy it directly from Apple.
I think it's really interesting, and I agree with you. I mean, there's at some point where you're like shelling out, what, over $1,000 for a new phone?
Way over $1,000.
Exactly, and so how do you do it? The plan with 4 payments, it's called Apple Pay in 4 internally. The longer-term payment plans are dubbed Apple Pay monthly installments, and the interest rates that Apple plans to charge for the monthly installments couldn't be learned. Affirm charges as much as 30% an APR rate, while other rivals charge a little bit less. So that will be fascinating to see what that is.
Apple has the credit card with Goldman Sachs. It has been in payments for years. The NFC-enabled iPhone allows you to make contactless payments with your iPhone and with your Apple Watch as well.
And a lot.
This is services too, right? It's trying to boost its services revenue.
And here's a little bit of market reaction. Affirm Holdings is down almost 11% here in today's trade. So
good decliner.
Yeah, exactly. Note that. All right, you're listening to Bloomberg Radio.
headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. 13 minutes to go ahead of the closing bell on this bank earnings Tuesday. Right now, J.P. Morgan Chase, Goldman Sachs, they are both lower. J.P. Morgan Chase down 1.4%. Goldman Sachs slumping by just about 1%. Tomorrow we'll be hearing from Citigroup, Wells Fargo, Bank of America. They're lower as well right now. Rest of the market declining. We're off session lows. Stocks are retreating from records. Bond yields rose as investors debate whether the Fed risks letting inflation get out of hand. The S&P is now down 11, down 0.3%. The Dow down 85, down 0.2. Nasdaq down 36, a drop of 0.3%. 10-year yield holding at 1.41%. We've got gold, little change now, up 70 cents the ounce at 18.06. West Texas Intermediate crude up 1.7%, 75.33 a barrel. Again, recapping, stocks lower, S&P down 11, down 0.3%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
Just drive, baby.
It's the question that drives us.
This is the drive to the close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, just about 10 and a half minutes left of today's trade.
Time flies, Carol, when you're having fun.
It's been a busy 2 days.
It has been a busy 2 days.
A lot going on, and equities definitely off their highs of this session. Charlie breaking down those numbers. We're down across the board, just about 0.3% down on those major equity averages. Let's get to it with Yana Barton. She is co-director of global of growth equities at Eaton Vance. Co-director of growth equities. Let's get it right at Eaton Vance. On the phone from Boston. Yana, nice to have you here with us. How are you?
I'm doing great. Good afternoon. Good to be with you guys again.
Yeah, good to have you here. It's a funny day, bank earnings. I don't know. What is it that you think we should be focusing on in today's trade?
Well, there's a lot that is coming at investors, and I think the market is reacting to pretty much a little bit for everyone. I think, when you think about the marketplace as a balance sheet, there are plenty of assets and liabilities. On the plus side, I think we've got a ton of confirmation that economic recovery is with us. Very positive comments from Jamie Dimon and the rest on the consumer spending and the sentiment. But on the flip side, obviously, the million-dollar question on the stickiness of the inflationary pressures and whether it remains with us for years to come or just a couple of months is kind of confirmation of the fact that inflation is heading higher. But I would say it's heading higher alongside higher growth rates. So that equation, if holds, is okay for now.
Well, is it heading higher, though, permanently, or is it heading higher in a way that lumber prices headed higher? Because if we look, and we talked about this with Carl Riccadonna from Bloomberg Intelligence, Bloomberg Economics, earlier in the day today, he pointed out that the prices for used cars and trucks, they jumped 10.5%, but that was responsible for a third of the rise of the index.
Yeah, that's a fair point, Tim. And I think many of your guests previous to me stated it correctly, which is some of these pressures are truly going to be transitory and some are not. Lumber is a perfect example where it was transitory and now we're something like 40% off where we were just even a couple of months ago. Wages, for example, you can't give somebody a raise and then take it away. So I think the answer to the question ultimately is pricing power. That's something that we've talked about. Companies that have it and can pass it on, Pepsi being a perfect example of that, will not see as much detrimental sort of impact to the margins as companies that have to eat the higher input costs. So again, it's a little bit of everything, and we just have to be patient and watch what the market is giving us.
So you're not worried about runaway inflation?
Not yet. Not yet. But I think what we are worried about is going after sort of this theme that was taking a hold in the beginning of the year, which is this reopening trade, this value trade, irrespective of, legitimacy and sustainability of that trend and that growth rate. And I think the most important thing for investors to focus on is a balanced, diversified approach in stories that are stock specific, meaning secular growth stories with addressable market that is disrupting alongside stable growth opportunities like a Pepsi, for example, and others that provide that sort of buoyancy and provide that eligibility to kind of play in both sides of the trade.
What are some other of those stocks that you're betting on?
So some other ones, interestingly enough, where I would go is with laggards. I mean, that's one area of the market. Unfortunately, we've got something like 6 areas of the market that have lagged the S&P 500. So I would go where the price performance and the valuation has already been reset. Technology is actually a perfect place for that. I think we're undergoing that right now, particularly within the hardware and equipment area of the market. S&P 500 is up something like 17.5 percentage points. But tech, while definitely regained some leadership, is still lagging. Another interesting area is chemicals. Believe it or not, while materials is underperforming, interestingly enough, chemicals is trading at a discount to the market, cash flow yield in excess of 4 percentage points, and has growth rate that is double digits. So that's another area.
Hey, I got to ask you, your Eaton Vance Growth Opportunities Fund, it's up about 42% in the last 12 months, 91th percentile, so beating most of its peers in that category. The top names, Amazon, Microsoft, Alphabet, PayPal. I mean, these are a bunch of your big growth names. So are you guys still all in on this?
Yeah, I think just as a note, I'm actually no longer a PM of that strategy, but I have a ton of my own personal investment associated with that strategy. I think growth is a place where you want to be right now. And the names that you mentioned have more cash on hand, have more top line growth, and I would argue more pricing power than many of the companies that we talk about. So I think growth at a reasonable price is where you want to be. And many of those names, to be honest with you, are trading at a discount to their growth rate.
Oh, that's interesting, because I was going to say Dave Wilson was talking about technology in particular being a little hot in terms of valuation and kind of making the comparison to what we saw in the tech bubble. And so I did wonder are you comfortable letting some of these names run a little bit hot because of who they are and their growth opportunities and possibilities and potential versus maybe some other names?
That's fair. I think tech is one of those areas of the market, like industrials, where you have a ton of different industries. So there's definitely a lot of enablers and software plays that have had tremendous price appreciation. But if you take a step back and you think about all the things that we've been talking about, identity governance and cyber attacks and all of those things, there is still this wallet share that is transitioning, and there's still not enough money being spent on the most important things right now, and that's infrastructure as we think about sort of this digital world and digital economy that we're part of. So I think we just have a lot of investment that is still yet to take hold when we think about the overall IT spend in being in trillions of dollars and less than 10% being spent on security or other sort of enabling things.
Hey, Yana, I want to jump back to something that you said earlier in our conversation. You said you're not concerned, and this is because this is what the market is doing today. This is what it's thinking about. You're not concerned about inflation yet. When will you be?
I think, stagflation is the most hated word in economics, which is when you just don't have enough growth to offset these taxes to your bottom line. And what we need to be mindful of, and this is why I think, investors will benefit from being active in the market and responding to what the market is telling us. Right now, what it's telling us, exactly what you mentioned, is that if you sort of decipher where the inflationary pressures are coming from, a third of it is driven by, demand and supply dynamics that we believe are going to be transitory, some supply chain dynamics that we also, they might be more lingering than we'd like them to be, but should be transitory. So I think what you need to be mindful of is cause and effect and understanding what are the sources of the inflationary pressures and how do companies sort of offset them for the longer term. And that's why I go back to the big guys that do have the pricing power and can do well irrespective of the inflation levels that we're living with.
And I do wonder, when do we respect the bond market? Do we respect it? You know, sometimes we blow it off when it gets too low, saying, well, that can't be real. And then when it goes up, we're like, oh, wait, that's real. So it's interesting kind of investor perspective on all of this. Yana Barton, thank you so much. Co-Director of Growth Equities at Eaton Vance, joining us once again on the phone from Boston. Speaking of that Treasury trade, we did have that 30-year auction that definitely dragged down the equity trade. 10-year note now with a yield of 1.40. 5-year 0.84, and you've got the 2-year note with a yield of 0.02.
You saw equities rallying before that.
Yeah, supported by technology in particular. But again,
the NASDAQ 100 reaching record high today earlier.
Yeah, I think it's the third consecutive in a row. So we definitely did see support within the tech sector, but it's definitely got a different feel. All right, everybody, get ready. Coming up next, we're going to be joined by our Bloomberg TV team for Beyond the Bell, live on Bloomberg Radio, Bloomberg Television, and on YouTube. We're counting you down to the closing bell on this Tuesday.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick, Caroline Hogg, Taylor Riggs, counting you down to that closing bell. Here to help take us beyond the bell, Carol Massar, Tim Stenovic, bringing together our Bloomberg Television, radio, and YouTube audiences. It is a global simulcast. Carol, we came into this day, a lot of talk about that CPI print. It certainly didn't disappoint. I guess the question is, do you believe it's permanent or transitory?
You know, Yana Barton was just on with us from Eaton Vance, and she was making this point that, you know, there's something for everyone in this marketplace. There's economic recovery, there's inflationary concerns, there's Jamie Dimon being positive about the consumer and consumer spending. So there's a little bit of everything, which maybe, you know, explains we were higher and then we were lower. And you definitely, though, have seen some kind of redirection when it comes to the Treasury trade, Tim.
Yeah, at least with equities today, Carol, it looks like that investors really digesting the bank earnings and then also the CPI data. And then, as you mentioned, tech shares earlier in the day actually rallied. The NASDAQ 100 earlier in the day reached a new record, for a third consecutive day, but that changed this afternoon. It looks like it's going to finish lower. But look, we are just at the beginning of earnings season. We have heard from a couple of big banks. We have the other big banks later this week, and we're going to get more insight into whether or not that analysts can actually think that the equity prices are supported by the results.
We're tired.
Tim sounds exasperated with this market, but it feels like a Taylor Riggs kind of a day, because Taylor, it turned sour on the equity market because of what happened on the 30-year auction.
Oh, weak, not an unhinged kind of bond auction that we got, at least on the 30-year, Romaine, which is really when you saw yields really start to tick higher and some of the concessions that had to be made. And frankly, it was the B of A Fund Manager survey that said that this morning. The big rotation out of cyclicals is because there are fewer people that are optimistic on the economy.
34,896 and change right now on the Dow Jones Industrial Average. Obviously, it always takes a few minutes for these numbers to settle, but you're basically down about 100 points on the Dow. That's down about 0.3%. Similar story for the S&P 500, down about 0.3% or about 15 points. The NASDAQ Composite down 56 points right now, down 0.4%. And Taylor was just alluding to that Bank of America monthly fund manager survey, basically talking about how everyone is scaling back their expectations for that cyclical boom, and nowhere was that reflected today than in the Russell 2000, down 1.9% here on the day. And this really completes an interesting rotation, because when we came into this month, in July, Carol, the Russell 2000 was outperforming every major index out there, the Dow, the NASDAQ, the Philadelphia Semiconductor Index, you name it. As of today, it's trailing all of those indices on a year-to-date basis.
Which is significant considering the move that we had seen. Hey, I do want to mention a headline crossing the Bloomberg terminal. Blank Check Company's acquisition of space cargo firm Momentus deal has been dealt a serious blow by the SEC, accusing both entities of misleading shareholders just weeks before investors were slated to vote on the deal. If we think about manias this year, folks, SPACs has been one of them. Take a look, and you can see Stable Road acquisition, that's back down about 5.7%. But this has been one of the manias of this year, but there's been some concern about all the frenetic activity, about transparency, what we are knowing, because going public through a SPAC, a blank check acquisition, it's not the same thing as the roadshow route. And so you don't get all of the information and the specifics. But anyway, something to watch here in the after hours trade, Tim.
Yeah.
And Taylor. Sorry.
You know, Carol, as we take a look at some of these sector levels on the winners and the losers, frankly, there's a lot of red on the screen. So let me start at the bottom of that, because it is this cyclical rotation out of value back into growth, with autos, banks, real estate Consumer durables off anywhere from 1.3% to 2.25%. So those are some of the big sector losers on the day. We migrate north. Frankly, there are only 3 sectors in the green, 2 of which we know you're up 0.3 to 0.8%. Software and services and tech hardware, because it is the rotation back into growth. And then, of course, there is food and beverage led by, well, PepsiCo. Carol.
Is that a perfect setup for me? Thank you so much. PepsiCo up 2.3%, just a little bit off its highs of the day. Everybody's eating Fritos, including me. The company raising its forecast. Sales jumping the most in a decade. Eateries reopening, restaurants reopening, bars and stadiums reopening, and so you've got a lot of people diving into lots of bags of chips. So we saw PepsiCo up. Tech standout. I think this is important. Chinese big tech companies, Chinese e-commerce giant JD.com among them. Baidu was also up, the ADRs that trade in the U.S. All of them rebounding as investors' concerns kind of easing after Tencent Holdings received official approval for its purchase of search engine developer Sogu. So getting a deal done despite increased Chinese scrutiny of big tech, 4.6% higher. At JD.com. Electronic Arts, top performing the S&P 500 up 1.3%. Getting upgraded to outperform from market perform over at BMO Capital Markets. Price target up to 168, Tim, from 150 a share. Closed at 143 and change.
Oh, well, people may be eating a lot of Fritos, but not many people are getting 787 Dreamliners, and that's why Boeing finished the day down more than 4%. The company said it would deliver fewer of those 787 Dreamliners this year than originally planned. This as mechanics expand their inspections for those tiny structural flaws in the jets amid a temporary grounding. We're also keeping a very close eye on the big banks. JP Morgan finishing the day down by about 1.5%. It was the best quarter ever for investment bankers. Fees from advising mergers and underwriting stocks, those soared 25%. But the bank did say that it would spend $1 billion more than it previously said for guidance. Part of that had to do with compensation. Jamie Dimon said, quote, "We're going to be competitive in comp no matter what it takes." A similar story playing out with Goldman Sachs, finishing the day down by close to 1.2%. Earnings did beat expectations, but like JP Morgan, a worse than expected slump in fixed income trading, rapidly rising costs, and some uncertainties for the future.
And DJ Diesel getting in on the Affirm business model as well with Apple, it would seem. Let's go cross-asset, guys, because I'm looking at what happened in the FX markets. This is the story of the inflation data coming in so strong, high since 2008. So your dollar goes higher, up 0.5%. The euro goes lower by some 0.7%. The pound was weakening as we have worries about coronavirus over there. But clearly, this is actually interesting that you see a dollar strong kind of story, but also an oil strength story, up 1.6% on WTI crude. The IEA warning of a supply crunch. We're all worrying about more supply coming onto the market from the likes of Iran. That's not shaping up, and many worrying that perhaps we will see some sort of pullback in supply. The demand-supply dynamics mean we go to the highest in about 33 months, 2.5 years for Brent crude, up 1.8%. I'm looking also at sovereign bonds, and this is a story of, well, inflation data, meaning that we're worrying about rate hikes, a more hawkish Fed. The dollar went higher because yields pushed higher too. And I know that's something you're keeping a keen eye on over at Taylor.
Incredible. 8:30 a.m. this morning, the CPI data that was hotter than we expected meant that you were seeing a flattening of the yield curve. All of that changes at 1 p.m. when you have a 30-year bond auction that needs some significant concessions, and then yields rise across the board. And Carol, that really folds into one of our big conversations about CPI, where what do you do if you're a Fed, where you get the fastest monthly rate of change since 2008, and yet if a third of it's used car prices that are transitory, there's something for everyone.
You call up Carl Riccadonna of Bloomberg Intelligence, because that's exactly what he said. He said 10% of the move in CPI and 56% of the month-over-month increase was because of those reopening categories. So whether it's new, used cars, car rentals, hotels, airfares, you have to parse through the data, right? Really understand it to figure out, are these potentially, remain transitory factors, or are they something that stays with us a lot longer?
Yeah, I mean, this is a debate, and of course, all of the wonky economists with all their fancy degrees will sort of wring their hands over this. But when you look at the price action in the market, I think the market, at least for right now, doesn't seem to necessarily be buying what it's hearing out of the Fed, at least out of Jay Powell here. There's a lot of evidence on the ground here, at least as it relates to the housing market and even to a certain extent the labor market, that maybe there is something a little bit more persistent, a little bit something more sticky here that folks need to be worried about. Used car prices, sure, they'll come down, but the wages and some of those other pressures, guys, I don't know. That's the big question.
Yeah, it's a question that I'm sure that Fed Chair Powell will be asked about tomorrow when he begins his testimony on Capitol Hill. Again, though, it's worth repeating because half of the gain in today's numbers were those obvious categories that have to do with reopening. New and used vehicles, vehicle rentals, airfare, hotels, even intracity transit as people go back to work. And look, if they're not riding public transit, they're paying more for Uber and Lyft.
Yeah, and Can I just jump in? I mean, you mentioned transit. I'll use that as a wonky segue here into American Airlines, which is actually pre-announcing its 2Q results here, pretty much in line with what a lot of folks are looking for. Basically, you're talking about a decline in 2Q revenue of 37.5%. But get this, they're comparing it not to 2020, but of course to 2019. So basically, a 2Q comparison from 2021 to 2019 here, as a lot of these airlines want to sort of measure themselves based on pre-pandemic levels, and based on that measurement, not good. But again, these numbers relatively in line with what the street had already priced in.
And speaking of what the street is priced in, we push forward to bank earnings as well tomorrow, Caroline, where Shanali coming out with a great conversation with us about M&A and some of the bankers taking charge, as perhaps maybe some of the trading is less than stellar this time around.
I think it was notable that financials underperformed on the day when yields went higher. That's always meant to be better for their business model, but it was a day more when we looked at, is it as good as it gets? Are we at peak inflation, peak growth, and are we never as good as it
Carol,
gets?
before you
Remain
go,
always gets better.
No, I don't. Carol, just real quickly, I'm told you got a big interview coming up a little bit later this afternoon.
We do. John Rogers of Ariel Investments, and we're going to talk to him about the market environment, see what he thinks, talk about banks as well. We've got Brian Moynihan also coming up, the CEO, Brian Moynihan, the CEO of Bank of America. That'll be coming up tomorrow, and then we've got John Rogers. So we'll talk about the market environment and then also how to reduce the wealth gap that we have in our society. All right, guys, that's going to do it for our cross-platform coverage on Bloomberg Radio, Bloomberg TV, and YouTube. We're going to see you again, same time, same place, tomorrow.
This is Bloomberg Business Week with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
All right, so we're setting up for another interesting day. Looking forward to talking with John Rogers about this market environment, how he sees it. He's a deep value guy, and so where do you find the opportunities? But also, he is someone who's very thoughtful about how to, really bring Black society, minority society into the financial infrastructure because they have largely been left out.
Yeah, we've done so much reporting on this in Business Week. It's been certainly a tale of two different recoveries, the K-shaped recovery. The wealthier have fared very well during the pandemic, and it's a very small portion of people.
Yeah, so looking forward to that. You have a good evening. I'll see you tomorrow.
I'll see you tomorrow.
Yeah, it'll be Wednesday, halfway through. You're listening to Bloomberg Business Week, and this is Bloomberg Radio. All right, back to World and National News and off to Nancy Lyons in her D.C. studio. Hey, Nance.
Hey, Carol. President Biden says Republicans are launching an assault on our democracy by passing restrictive voting laws.
21st century Jim Crow assault is real. It's unrelenting. And we're going to challenge it vigorously.
Speaking in Philadelphia, Biden says the nation is facing the most significant test of our democracy since the Civil War. Democratic Texas state legislators are taking dramatic action to stymie their state's latest effort to tighten ballot restrictions. They took a flight to Washington to keep their legislature from having a quorum that would allow legislative action. Well, the Biden administration is taking a new tack to convince young people that COVID vaccines are good for you.
The White House is enlisting pop star Olivia Rodrigo to get the message out. An official says she'll meet tomorrow with President Biden and Dr. Anthony Fauci and record videos urging young people to get the shots. She'll also answer young Americans' questions about them. Last week, the CDC reported just 57% of 12 to 17-year-olds intended to get the vaccine. The study said being better informed would make that age group more receptive to the shots. Last month, Olivia Rodrigo catapulted to the top of the Bloomberg Pop Star Power Rankings. In Washington, I'm Nathan Hager, Bloomberg Radio.
President Biden has picked Rahul Gupta to be the next director of the Office of National Drug Control Policy. The White House says Gupta is a former West Virginia health official who's most recently served as the top health official at the March of Dimes. If confirmed by the Senate, he would be the first physician to serve as drug czar. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons.
All right, you're listening to Bloomberg Business Week. Carol Masser, and joining me once again is Charlie Pellet. All right, I'm a little confused. Are you calling an audible here?
No, I'm not calling it audible.
You sure?
Yeah, exactly.
Right.
But
maybe later.
Yeah, perhaps. But here's what's going on. We've got a story from Dow Jones talking about the fact that customers are back at restaurants and bars, but the workers have moved on. The workers are saying, hey, I'm out of here. I'm getting a job in a different industry. May have to do with a lot of things, the challenges of being a waiter or a bartender, the grueling hours, or perhaps something else, and that is maybe better opportunities and better pay.
Exactly, which is not a bad thing, right, in terms of increasing your wealth. And it's something we're going to talk about with John Rogers of Airlie Investments. But John Tapper, who covers the restaurant industry and the bar scene, has talked about the lack of workers coming back. What is going on is we know COVID-19 forced restaurants, hotels, and bars to shut last year. Thousands of workers didn't just get pushed to the employment sidelines. Many have moved into new careers in digital sales, shipping, as you say, Charlie, mortgage financing, and other businesses that thrived during the pandemic in what some economists say could mark a lasting shift in the labor market for hospitality staff. This could be why you increasingly see the hospitality industry move towards automation.
I got to tell you, too, no, many of the bartenders that I know, speaking of automation, have you ever seen those automated bars where they've got these devices, these mechanical devices that will actually shake, mix, and pour drinks? But I digress.
Isn't that called a husband? Oh, sorry.
There you go.
Just kidding. Just kidding.
The other thing I wanted to mention too is I don't know if you saw the sign that went viral on the Burger King out of Lincoln, Nebraska.
No, tell me.
The workers quit en masse a couple of days ago. They then posted on the sign outside. It said, "quote We all quit. Sorry for the inconvenience." All the workers had a variety of grievances. They said, "I'm out of here." They quit. They posted the sign and they walked.
Just found it. We all quit. Sorry for the inconvenience.
Yeah, but no Whopper for me and you.
No, exactly. Wow. It's an interesting labor market, to say the least. All right, Charlie Pellet, thank you so much. This is Bloomberg Radio.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Paladel. Brands is boosting its adjusted earnings per share forecast for the second quarter. Its guidance beating the average analyst estimate. It was a down day on Wall Street. We opened higher, spent much of the day in the green, but in the end, a losing session for the Dow, the S&P, NASDAQ, and NASDAQ 100 index. Adding to that, the Russell 2000, Dow Transports down 0.9%. Russell 2000 lower today by 1.9%. NASDAQ 100 index down less than 0.1%. NASDAQ Composite Index down 55, a drop there of 0.4%. The S&P down 0.3%, down 15. Dow Industrials down 0.3 as well, lower by 107 points. 10-year yield 1.40%. Gold was down 0.1. I'm Charlie Pellet. That's a Bloomberg Business Flash.
And you are listening to Bloomberg Business Week. We do want to welcome our Bloomberg Television audience also joining us at this time. We are live on Bloomberg Radio, Bloomberg TV, and on YouTube. We've got a great guest, very familiar to our Bloomberg audience. We're talking about John Rogers of Ariel Investments. He's the chairman, co-CEO, and chief investment officer, and also here in our Interactive Brokers studio, our own Shartia Brantley, who is deputy bureau chief here at Bloomberg News here in New York City. John, we have a lot to cover, and we're so gracious that you found some time for us on this Tuesday. If you will indulge us a little bit, at Ariel Investments, you guys are watching the markets, watching the investment space. What do you make of today's market environment? Is there a little froth? Are you worried about higher interest rates? How do you see it?
We do think there's more than a little froth. You know, the enthusiasm that's out there, I know you guys talk about it on the show, what's been happening with the SPACs, what's been happening with all the IPOs, all of the meme stocks. There's just a kind of euphoria out there. Investment sentiment is very, very, very positive. And being a contrarian and independent thinker, those are all signs for us that we think the market is very top heavy, especially with the large cap growth stocks and some of the faster growing growth stocks. So we would think it's a time for caution, a time for conservatism. And if you're going to be buying, to buy the value stocks that are still undervalued.
And we know you like value, you're a deep value person. Do you also think, though, that we would see a correction within the equity markets, that is to be expected, whether it's a 10% correction or something more significant?
I think we could expect at least a 10% correction. You know, we have historically high PE multiples here. And the one thing I didn't mention earlier in the commentary is that we do think interest rates are going to be significantly higher than people anticipate. We think this higher inflation, we had inflation data today that was higher than expectations. We really do believe that we're going to be, getting 4%, 3.75% inflation for the next 4 years. And that'll force interest rates higher, which will mean those large cap growth stocks are going to be not so inexpensive when you factor in those higher discount rates.
And John, what impact do you think the growing COVID cases and the Delta variant, what that may have on investor sentiment at this time?
Well, it is problematic that we haven't been able to get more and more Americans to get vaccinated. It's extraordinary that this has become politicized, and as we all read about it in the Times about the Fox newscasters pushing against getting vaccinations, which to me doesn't really make sense at all. So it is short-term problematic. It's short-term problematic for sentiment. But ultimately, I do think that rationality will prevail. We will find a way to incentivize vast majorities of people around the world to take their vaccines, particularly here in America. We've got to fight this virus to the death, and we're going to get it done. We've made a lot of progress. And I'm confident we'll get the rest of this job done.
I know your focus is small and mid-cap stocks. Are you particularly concerned about how they may be impacted at this time?
Well, we are looking at that, of course, carefully and trying to make sure that our companies have the financial strength to deal with higher interest rates and higher inflation rates. We're spending a lot of time on that and thinking about the companies that will be able to come back strong from this recovery. So favorite names of ours we talk about all the time is Madison Square Garden Entertainment. They own the garden itself and the land around it. And if you believe in a recovery in New York real estate and the fans will be back in the arena to watch concerts and watch the Knicks and the Rangers. It's really a favorite of ours for this recovery. And the icing on the cake is a brand new sphere that they're building out in Las Vegas. I went to see it a couple weeks ago, and it's an extraordinary new entertainment vehicle that's never been seen before in the world. The quality of the sound system, the quality of the visuals is just going to be extraordinary. So that's our favorite recovery stock.
Well, it's interesting, too, that you talked about, you're watching your small companies, maybe the mid-cap companies really closely. I think, John, one of the things that surprised us so much during the pandemic is we thought, man, restaurants, certainly smaller businesses, they've been hurt big time. We've seen a lot of small businesses. But I think whether it's commercial real estate, there were a lot of things that we thought that we would see a lot more distressed assets. Is that still to come in your view?
Well, I'm optimistic in this recovery is going to surprise people by how strong it is. Now, again, the downside is the recovery is so strong that it's going to force interest rates higher and inflation higher. So we have to be careful about companies that are going to be susceptible to higher rates. When you mention real estate services companies, we like JLL, we like CBRE. We think those types of companies are going to benefit from all the transactions as people restructure their real estate going forward. So things that are going to benefit from this transition to a new economy, a higher inflationary economy, those are the kind of small and mid-sized companies that we're looking at and working on today, Ariel.
Even as we see the return to office efforts not be as, I guess, accelerated as maybe some CEOs would like to see at this time?
Well, I think, it has been sluggish here, at least here in America, but as we've done our worldwide checks, it's been remarkable how many of the European countries and Asian countries, people have been eager to get back to work, and people are filling up their office spaces. Now, I think that here in America, maybe we'll go to 3- and 4-day weeks in the beginning, and people will be slow to totally come back to normal. But I think, Americans, we're missing our colleagues. We're missing our friends. Business owners know that you need people in the office to be able to interact and inspire each other, share ideas, express different opinions, and move your companies forward. So eventually, over time, I think you're going to get back to more normality. Now, maybe people won't travel as much now that we've proven that we can do meetings by Zoom, and so I would be a little cautious around some of the traditional hotels, traditional airlines, that people will still travel for entertainment and vacations, but I think there'll be a lot less business travel that is maybe permanent because of the extraordinary technology and things that we've gotten used to as a society.
Hey, John, we're going to broaden out in just a moment, but I want to get back to what you did mention SPACs. We had that headline, the SPAC merger with space firm Momentus threatened by an SEC fine. Whether it's meme stocks, how do you, as someone who has been investing in the market for a long time, that we see increasingly disruption. You see traditional fintech, traditional technology companies, and also traditional banking companies, financial companies, increasingly gobble up some of these fintechs, or at least look at them much more closely. How will they ultimately impact our universe, our financial universe, longer term?
Well, I think you will, continue to see more and more mergers as time goes on. One of our favorite stocks is Lazard. They're a traditional investment banker. They're really, really good at putting deals together, and Ken Jacobs, their CEO, is terrific, and the team's terrific. So I think you're going to continue to see M&A. I know right now there's this push that maybe people are fearful in certain industries of too much consolidation and too much scale. But I just think over time rationality will come back because, in this new society, with all the things going on digitally, there's just so many ways for companies to compete with each other effectively. And there are exceptions. Of course, the Facebooks of the world and some of those giant companies that have become these huge unicorns. Well, maybe they need to be reined in on certain ways, but I think ultimately the vast majority of transactions will have to continue to occur because you need to have scale to compete with the giants. It would be unfair if the smaller and mid-sized companies can't have M&A and have to compete as smaller companies against these huge monolithic giant companies that are out there in today's economy.
If I can follow meme stocks, how often does somebody come up to you or you're at a social gathering on the weekend and someone's like, all right, John, what do you make of these meme stocks?
Well, it's interesting. We do get some of those calls. The guy that's, always brings my pizza from Gino's Pizza here in Chicago to my house, he's always asking me about different stocks and what's happening with the meme stocks. And in particular, of course, everyone wants to talk about Bitcoin and whether it's time to invest and did they miss it or not miss it. But then again, that's always a sign when you just have sort of average Americans who are doing great work in their day jobs, deciding they want to be stock pickers and follow trends at the peak. It's always a sign that you're getting toward a top, you know, and I think those are signs that we really are there. And as you know, Joe Kennedy always said when he realized that the Great Depression was coming, it was time to get out of the market in the 20s, when the shoeshine boy was giving stock tips to him.
Right.
And he realized that was a time for him to move out of the markets.
I always say that about during the real estate boom. I was at a yoga retreat and everybody was talking about their real estate investments. I knew, Shartia, that we had hit a boom.
Definitely. But John, are you at least encouraged that more Black investors are, investing, okay, maybe in meme stocks and looking at things such as Bitcoin and other cryptocurrencies at this time?
I do worry about it. And the good sign is we're getting more and more African-American investors, and places like Charles Schwab have really democratized the stock market, and it's very cheap to get involved, and you can do everything online and not be intimidating by traditional white shoe investment firms. So all that is really, really good. But the downside is often this happened with the internet bubble at the turn of the century. We get pulled in the market, get sucked into the latest themes too often because we haven't been as engaged in the stock market as white Americans. So I do worry that we're getting pulled into some of these risky areas at exactly the wrong time. And we know, the way that we came to this country, the traditions that we had to fight against, the Jim Crow, and all the challenges that we faced in our community put us behind the 8 ball when it came to investing and getting comfortable in the markets. And so again, whenever we get pulled in, I do worry sometimes when it's late in the game.
Well, let's talk about financial literacy and how that plays into alleviating your concerns.
Well, I think we need to continue to do more and more. We have just scratched the surface when it comes to financial literacy. During the Obama administration, I had the privilege to be able to chair his council on financial capability for young Americans. And we talked to the president about how can we get more financial institutions to partner with urban public schools to teach kids about the market, give kids real dollars to invest in real stocks, be role models for young people of color to get engaged in the financial services sector as career choices. So I think we have a long way to go because it's just so critically important that, African Americans get exposed to the markets at young ages. We know the wealth gap in this country has gotten larger and larger. We've fallen further behind because of the historical discrimination that we face in this country. So the way to catch up is to get folks involved in the best parts of the economy where the wealth and jobs are being created today, and learning about the magic of compound interest and getting comfortable in equities. Because we all know when you get a job now, you have to be your own money manager with your 401k plan. So financial literacy is more important in this country than ever.
John, how do we get there? The reason I ask is I actually came across a Federal Reserve paper that was done by a researcher about 10 years ago, I think, talking about the importance of financial literacy. I think about someone like, Warren Buffett, who talked about compound interest, knew it when he was at a young age. We have been talking about the importance of financial literacy across society for a long time. And I wonder, how do we really move the needle on this? Because I agree that this is something that unlocks is the key that kind of unlocks financial wealth for more Americans and certainly for Black Americans.
Well, I think one of the things I talk about all the time, my father bought stocks for me every birthday and every Christmas after I was 12 years old. And I got exposed to the markets at an early age and loved it. There's a program in New York City Rise, that is doing that with young people, getting kids into 529 programs at, right in kindergarten and on the way. And at the Ariel Community Academy, that's now 25 years old, we give kids real money to invest in real stocks, and they get to see the money grow from kindergarten through 8th grade. And I think that's just so important. You got to get exposure, get your hands a little dirty with the markets, learning how to do the research, seeing the inevitable ups and downs, but seeing how markets steadily climb. Even after you have some ups and downs, we come back from downturns and bounce higher. So I can't overemphasize the importance for corporate America to work with public schools, get public schools to have robust financial literacy programs, and get volunteers from the corporate community to get in there and talk with kids about how to do the research and the magic of our capitalist democracy, that really builds wealth over time.
Just a quick follow. Should it be mandatory in schools? I personally think that kids should be starting in kindergarten learning about financial literacy. Make it part of the curriculum. Do you think that's what needs to be done?
I think that's really critical. I think that's exactly right. You know, I know local communities make the decisions on their own local schools. It's hard to dictate that federally, but it's, you know, I always joke with my friend Arnie Duncan, the former Secretary of Education, that, you know, the French class is maybe not as important as that financial literacy class. You know, I think I've been to France 5 times in my life, and I spent 5 years studying French. Financial literacy is so important to our economy and so important to our country and in all communities.
Well, there have just been so many efforts, if you will, announced post George Floyd. You know, your organization has launched Project Black. Can you just tell our audience a little bit more about that and what has been the response so far?
Well, our co-CEO created Project Black in partnership with J.P. Morgan Chase and Jamie Dimon. You know, Melody Hobson had this vision, this idea that we would create a fund that would build stronger Black-owned and Latinx businesses and get them to scale. We feel like too many of the programs are all about helping small micro businesses get small loans to build their businesses. We feel we want to help build capital for companies to be really scalable, where they can create real multi-generational wealth, hire hundreds if not thousands of people, and have a permanent impact on our society. At the same time, we'll work with decision makers at corporate America to encourage them to do business with minority businesses in the parts of the economy where the wealth and jobs are created today. You know, we know financial services, we know wealth's created in technology, media, et cetera. And sometimes well-meaning supplier diversity programs have not really encouraged minority businesses to have real opportunity in the parts of the economy, again, where the wealth's created today. So that's what Project Black's all about, is to make sure that corporate America is doing business with everyone and that we're building businesses of scale, which we think will have a real permanent impact and positive impact on our society. It's going extremely well. We're really busy out there. We have a great board of directors, a great CEO. It's just been, you know, off to a great start.
Are you encouraged by the other initiatives such as, 110 to provide those family wage-sustaining jobs for, Black Americans without, a college degree, and some of the other initiatives announced by some of the big banks such as Citi and Bank of America? Does it take this throw everything at the wall approach to close the racial wealth gap from the entry-level positions up to C-suite and board activity?
I do think we have to be pushing in all these different directions. I think that's very important. Coincidentally, I'm actually having a meeting with the CEO of that organization this afternoon. I know Ken, small world, and I know Ken Frazier has done a great job as co-chairman of that organization and has built together a terrific board of leaders and advisors. So I think it's definitely the right thing to do. And I think, so these things are not competing. As much as we want to build strong minority-owned companies that will employ people of color, we want to make sure that people of color have a fair opportunity to fully participate in the large majority-owned corporations that often are publicly traded and have such an impact. So we need to be doing both things at the same time. And at the end of the day, I'd be remiss if I didn't remind people that as these young people get involved and they're making $50,000 a year, to make sure they're engaged in their 401k plan and investing in equity, so they will be willing to be able to retire comfortably after they get these careers started.
John, what do you think about President Biden's recent sweeping executive order? And part of what he was looking to do was improve the plight of workers, the mobility of workers, reducing the gap between wealthy, very successful companies and those workers who aren't tapping or benefiting equally into their success. Is he on the right track? Is this going to help?
Yes, I really do think that the Biden administration is doing the right things, building back better, being having such a commitment to diversity and inclusion, and making sure that minorities are fully a part of our capitalist democracy. We've had interactions with many people in the White House and many people that are on his team, and it's really been a breath of fresh air. I'm so optimistic of this type of leadership. And one of the things we're working with them on is this idea that we want to be able to see more and more of the federal contractors working with minority companies and being transparent with how they spend their money, because ultimately that's where the wealth opportunities will come from.
And I guess that plays into Project Black, right? How do we get companies to go from being tier 2 suppliers to tier 1? Well,
you have to remind them. One of the things that the University of Chicago created this term about a dozen years ago called business diversity to replace the term supplier diversity. And the University of Chicago has gone from a very small number to now over 95 professional services companies do business with the University of Chicago in everything the University of Chicago does, from advertising to public relations to government affairs to technology, architecture, money managers for the endowment. Really having people of color having to have a chance to fully participate. That's what we have to get that kind of vision into corporate America and get away from this term supplier diversity. I say it's like, you know, using Blockbuster Video versus Netflix. Supplier diversity is so out of date. It typically is kind of a modern day Jim Crow. Supplier diversity programs encourage more minority construction firms and catering firms, janitorial services firms. That's important. Those are vital jobs in businesses. But we all know wealth's being created today in private equity, hedge funds, venture capital, what's happening in Silicon Valley with all the top tech firms, what's happening on Madison Avenue with all the media firms. We want to be included in everything if you're really trying to build wealth, and we have to remind corporate America of that.
John, just got about 50 seconds left. Shartia and I, when we were prepping to talk with you, one of the things we wanted to ask you was, how do we really move things forward? Do we need to recreate Black Wall Street? And we know that you're a great-grandson of J.B. Stratford, considered one of the key architects of Black Wall Street. Is that what we need to do to really move the needle? And forgive me, just got about 40 seconds left.
Yes, one of the things that was great about Black Wall Street, and my great-grandfather had the Stratford Hotel, he worked with Black contractors, he worked with Black lawyers, he worked with all the other Black entrepreneurs in Tulsa. They worked together and the money flowed through that community. We have to work together to give opportunities everywhere, and that was part of the beauty of Black Wall Street and what was happening there. And we got to get that back in Tulsa as well as around the country.
John,
equal economic opportunity.
John, thank you so much. So gracious with your time, and we really appreciate it. We covered a lot of ground, and we hope you'll come back real soon. Be well. John Rogers, Chairman and Co-CEO of Ariel Investments on the remote access there from Chicago. Shartia Brantley, thank you so much as well. Our New York Deputy Bureau Chief here at Bloomberg News, and really leads our diversity coverage when it comes to our Bloomberg Live team. All right, you are listening to Bloomberg Business Week. Let's get a check on world and national news, and Nancy Lyons in D.C. Hey, Nance.
Hey, Carol. President Biden today is making the case for broader access to voting. He spoke earlier this afternoon in Philadelphia, where he says, "We the people began."
Some things in America should be simple and straightforward. Perhaps the most important of those things, the most fundamental of those things, is the right to vote. The right to vote freely.
Biden spoke at the National Constitution Center. He says the 2020 election was the most scrutinized in history, and he added the big lie spread by Republicans is just that, a big lie. His speech comes as Democratic state lawmakers from Texas take a stand against voting legislation making its way through their state legislature. They flew to Washington, essentially preventing a quorum and blocking passage of the bills. Their Republican colleagues are authorizing law enforcement to find and bring them back under warrant of arrest if necessary. Well, there's a surge of the Delta variant in those states with the lowest vaccine rate. So Republican lawmakers are urging their constituents to get a shot. Senate Minority Leader Mitch McConnell says there are 3 highly effective vaccines.
If you're a football fan, we're in the red zone, but we're not in the end zone yet. And we need to keep preaching that getting the vaccine is important.
McConnell is one of the prominent pro-shot voices in the Republican Party. Red states that voted for Trump continue to rank behind blue states in terms of the vaccine rollout. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts.
All right, Nance, thank you so much. Let's bring in Charlie Pellet. Charlie, I know you've been watching this company. It's a company story. It's a stock story today. Boeing shares down more than 4%, 4.2. Stock pretty much closing at its lows of the day, slumping after the playmaker said it would deliver fewer 787 Dreamliners this year than originally planned as its mechanics expanded their inspections for tiny structural flaws in the jets amid a temporary grounding. It's like, wait, What?
Yeah, exactly. It's the 787 Dreamliner, beautiful plane, a favorite for people who like to fly long distances. Boeing, by the way, did lead the Dow lower, but a source telling Bloomberg that Boeing has uncovered an additional manufacturing problem with that Dreamliner. It comes as it works with regulators to restart deliveries. The issue, according to the source, pertains to wrinkling in the forward pressure bulkhead in the jet's noses. The defect is not considered a threat to flight safety.
And we know it's just been a rough couple of years for this company. Manufacturing flaws that have disrupted delivery since late last year continue to weigh on that 787 program. And really, it's a bigger story. It's about Boeing's own financial turnaround. We know that there's been executive changes and so on and so forth. But this is something that, it just seems like it can't get ahead of it.
Indeed, and Boeing, as you know, has halted deliveries of the aircraft since early May. Regulators review how it determines where to inspect for those tiny imperfections that have cropped up on the interior lining of the jet's carbon fiber airframes.
To be fair, the issue is not considered a threat to flight safety. This is coming from a company spokesman, so just wanted to put that out. Boeing planning to work in its North Charleston factory for a few weeks and reassign additional workers to inspect and repair the carbon fiber jets for gaps that are larger than the width of a hair.
Indeed, and it should point out, too, that Boeing's got 100 Dreamliners sitting around in storage. Waiting to restart deliveries is absolutely crucial to the company's turnaround.
Yeah, exactly. And I guess the company statement or the statement that came out or the FAA statement said that this was part of an ongoing system-wide inspection of Boeing's 787 shimming processes required by the FAA. All right, Charlie, thank you so much. This is Bloomberg.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. Stocks retreated from records. Bond yields rose as investors debated whether the Federal Reserve risks letting inflation get out of hand. A warning about valuations from John Rogers, Chief Investment Officer and founder of Ariel Investments, who was interviewed moments ago right here on Bloomberg Business Week.
There's just a kind of euphoria out there. Investment sentiment is very, very, very positive. And being a contrarian and independent thinker, those are all signs for us that we think the market is very top-heavy.
S&P down 15, a drop of 0.4%. The Dow down 107, down 0.3. NASDAQ down 55, a drop of 0.4. 10-year yield 1.41%. Gold little changed, up less than 0.1%, 18.07 the ounce. West Texas Intermediate crude up 1.4%, 75.14 a barrel. Recapping stocks lower, S&P down 0.35%. I'm Charlie Pellet. That's a Bloomberg Business Flash.
All right, got it, Charlie. Thank you so much. Well, the Female Founders Fund invests in what they call women building category-defining businesses. They recently got some additional funding to do just that. Let's get more on the work that they are doing and the outlook from Anu Dougal, founding partner of the Female Founders Fund. She joins us on the phone in New York City. Anu, nice to have you here on Bloomberg Business Week. How are you?
I'm doing well. Thanks so much for having me.
Tell me about the past year. What's it been like for you?
So, today is obviously a big day for us. We just announced the closing of our Fund 3. Mm-hmm. And, I have to say, looking back on the past 12 months and having to go through a fundraising process, I think one of the highlights was the fact that it was possible to do this all sitting at my dining table.
It's amazing, right?
Would have never happened before. And, it was definitely tricky in the sense that I think a lot of institutional investors had not made investments in funds where they hadn't met the team, hadn't met the manager. But we were very excited by the reception and very excited about the fact that, we were able to not only get to our goal of 50 million, but to exceed that. So overall, very excited.
And so total assets under management, is it right, 95 million at this point?
That's correct.
All right. So what is it about female-led businesses or for females that you think is different and that certainly has been undercovered by the investment community? We've done a lot of reporting on it here at Bloomberg. Why is that?
So, there's a couple ways to answer that question. I think, looking back to when I started the fund, less than 2% of venture capital went towards women. And if you looked at the profile of the majority of investors in Silicon Valley at that point, they pretty much looked the same. And, when you think about the trajectory of an investor, you're really investing in a company where you are going to be on the board for, anywhere from 5 to 10 years. So you're going to invest in companies that you can relate to, that you're excited about. And if you don't have diversity as part of your investing team or represented as part of your investing team, you really get and invest in things that and that you're comfortable with. And so I think, you need more inclusion, you need more diversity, both as it relates to investors. And then ultimately, I think that leads to more funding for companies, that are led by women and that are led by people of color.
Well, it's interesting that you say that, too, because I do wonder, I think it's great to see you focusing on female-led efforts, if you will, or the women, category or how you define it. But I also, as you said, diversity is so important. So how do you make sure, since you believe in diversity, how do you make sure that as you do your investments that you've got kind of a diverse team looking at investments?
Yeah, so I think, our team is pretty small, and I think at least on the investing team, we all have very different kind of life experiences and cultural backgrounds, and okay. I think that's us to make, looking at Fund 3, we've now invested in 7 companies, 70% of which are BIPOC, and I think, we're very proud of that, and so, we do make a concerted effort to go and look for different channels of deal flow that we believe better represent, America today.
And BIPOC, just remind me, because that's an acronym, and what exactly does that mean?
So that's people of color as well as LGBTQ.
Okay. So It's interesting. So talk to me a little bit about your investments and how you pick them. Obviously, you've got more money to do it now with this latest fund. So what kind of investments do you look for as you, I'm assuming you get bombarded. Is that fair?
Yeah, I mean, I think, we have definitely worked hard to build a brand in the ecosystem. And, in terms of the investments that we're looking for, particularly as it relates to Fund 3, I would say there are a couple of categories that we're excited about. So one would be the consumerization of digital health. We've, in retrospect, done quite a bit of investing already in the space. So Maven Clinic, Real, Tempest, Arianna Huffington's Thrive Global, those are all examples of companies that we feel are truly kind of evolving and revolutionizing healthcare. And I think post-pandemic in particular, there's a need and a recognition that we need better products and services to serve the consumer. The other area of interest for us is education. I think there hasn't been enough investment and enough innovation, quite frankly, in this space. And education, we believe, is a lifelong experience. So shouldn't just end, after college or postgraduate school. So how do you create platforms and options for people, to continue learning? The other area of interest for us is workplace efficiency tools. So, we're all zoomed out, and as we kind of transition into this hybrid, work from home, return to work model, how do we find better technology solutions that create a more seamless experience for employees and for small businesses? So those are a couple of the areas that we're excited about.
It's interesting. I was just talking with John Rogers of Ariel Investments, and, we increasingly talk with him about the gaps in wealth that are in society. And it's amazing that, and we talked with John Hope Bryan of Operation Hope yesterday about, I think, a city study that how much we leave behind in GDP by ignoring swaths of our population, whether it's women, whether it's minorities, whether it's Black Americans specifically. And so what can you tell us about the returns that you're seeing? Because I do believe these are the things that ultimately get, a wider array of investors their attention when you say, look, I invested in this, woman-led business or for women business, and here's my returns. What kind of returns are you guys seeing?
Yeah, I mean, we, I think we're very excited about what we've seen. As I'm sure you know, seed investing is a game.
It takes a while, and it can be tough.
Yeah, it takes a while. But we have one exit under our belt, Eloquii, which was acquired by Walmart, fast fashion to plus size market. Last year, P&G announced their intentions to acquire Billy, and we have a couple of other announcements coming up soon. So. Our goal is to be as good, if not, better in terms of returns as it relates to our peers. And so, I think the early numbers that we're seeing are an indication that that's, things are moving in the right direction. And, the fact that we, I think, had the interest that we did for this fund, I think is also a testament to that.
It's pretty impressive, too, the folks that line up and the companies that line up to be a part of your funds, whether it's Goldman Sachs, Cambridge Associates, Melinda French Gates, her Pivotal Ventures. How do they help you in terms of maybe guiding you in terms of investments, or what's their input? Just got about 30 seconds here.
Yeah, I mean, I think it's great to have partners. The ones you mentioned, I think, have been incredibly supportive. And I think more important for us are aligned in the fact that the world is moving in a direction where you need to have diversity. And it's incredibly important for that to happen at the fund level, at the founder level, and also at the company level. And so I think, having a group of investors who care about that and are on the same page has been incredibly important for us.
Well, great to check in with you, and I hope you'll come back and let us know how things are going. Anu Dugal, she is founding partner at Female Founders Fund. She's joining us on the phone from New York City. Anu Dugal, let me just get that out right there, of the Female Founders Fund. All right, that's going to do it for this edition of Bloomberg Business Week on this Tuesday. As we know, markets finishing off their highs of the day. Get ready for another round of big bank earnings, including Citigroup reporting tomorrow morning. For the whole Business Week team, I'm Carol Massar.